Here it is, and then we're going to break it down in a second. Check it out.
But to me, this is why the S&P had a great first 6 months. Maybe it needs to consolidate those gains. But now Russell 2000 has an 11 median PE, earnings growth 800 basis points faster. And, it just posted 11 days where 10 out of 11 days had a 1% move. The 9 times it did that since 1979, when you weren't in a bear market, we were up 100%, 1 month, 3 months, 6 months, 12 months later. 12-month average gain 40%. There's a lot of opportunity in small caps. Part of it is that there's a lot of overlap. When the Fed cuts, that's lowering cost of money. That's good for small caps and the regional banks.
You don't think the large caps are done. You just think it's a slowdown for the S&P 500 on a broader level?
Yes, that's right. I think the Mag 7 was very attractive at the start of this year because growth was scarce and they've had great visibility. And they're not expensive. 27 times earnings isn't demanding. But now that there's a visible catalyst for small caps, I think investors are taking some profits up. NASDAQ was up 20% and putting it into small caps. I think for the month of August, small caps can do something more than 15% even because they've underperformed so dramatically. And the type of move we've seen just in the last 2 weeks is something that only happens at the start of a pretty significant advance for small caps.
Tom Lee is talking about one thing and one thing only, which is that the summer is going to be owned by these smaller companies, the small caps. He's saying that by the end of August, the small caps index, the Russell 2000, the IWM, is going to run up by 15%. For an index to run up 15% in a month, that is wild. But what he's saying, this will be just a setup for another 40% until the end of the year. So absolute insanity. Now, what he's saying here is that the rate cuts by the Federal Reserve are so beneficial to all these smaller companies. And because the smaller companies have been lagging for so long, which we'll talk about in a second, the bounce effect, the rubber band effect we're going to see the minute it releases is going to be insane. So what he's saying here is that the 10% increase in the IWM index, the Russell 2000, the small caps we've seen for the past 30 days, that's just a preview. The little sell-off we've seen in tech a few days ago and the spike in the IWM, that's a preview. The real film, the real movie hasn't started yet and you still got time. And that's why people love Tom Lee, because he gives actionable advice, not just fluff and self-promoting crap. Now, look, I want to break down what he said today because, look, at the end of the day, you have to understand, mainstream media has 4, 5, 6 minutes with a guy. It's very, very quick. It's very brief. It's just the kind of the snippets and the bottom line. There's a lot of nuance in what he said. And if you don't understand this nuance, you're going to miss out on all of this opportunity because it's not as simple as it sounds. Number one, he's talking about a very simple process. So far, for the past 18 months, money went in one direction, from people's pockets and into the Magnificent Seven companies, the Nvidias, the Microsofts of the world, basically the leading companies in the S&P 500. It happened because interest rates were so high that these companies were viewed as a safe harbor because they have so much money, so much cash flow, they don't need to borrow money. So all these companies sucked all the money and basically went insane. What has happened is right now, money is going into an additional asset class, which has been ignored so far by the market, which is the smaller companies, the small caps, the IWM index, the Russell 2000. So money is going not just to companies like Nvidia, now people are investing in Abercrombie & Fitch or Fabrinet, companies that are worth $8 billion each. Literally nothing, an iota, compared to Nvidia or Microsoft. The entire value of the IWM, just to kind of give you a perspective here, the entire value of the entire Russell 2000 is not as big as Apple and Microsoft combined. And they're just two companies out of the Magnificent Seven. So it's a smaller index, you have to understand. But that's also part of its appeal right now because in a smaller index like this, you don't need a lot of cash to spike it to the moon. That's what Tom Lee is saying here. Now look, for the past 18 months, give or take, the S&P 500 went up by 40%. That is wild. Nvidia pretty much 10x'd itself in the past 18 months. At the same time, the IWM, the small caps index, did only 4.7%. So the S&P 500 for the past 18 months have pretty much 10x performance compared to the small caps. And that is going to change according to Tom Lee. The reason it's happening now has a lot of different legs, and I'll share them with you. And by the way, these explanations are not going to be in any particular order of importance or any such things, just out of convenience. So the first thing I want to point out is you have to understand that over the past 18 months, it was great, right? We all had fun. We all enjoyed ourselves. But what happened is that every day that the party went on, basically the S&P 500 have become increasingly more and more and more expensive with every passing day. Right now, ballooning all the way to almost 30 price to earnings ratio. That is very expensive. On the other hand, the IWM is now trading at below 10 price to earnings. So relative to earnings, the IWM is 3 times cheaper right now than the S&P 500, where traditionally it should be the other way. Usually the IWM, the small caps, the companies that have most of their potential in the future, are trading at a much higher valuation compared to the earnings. So it is a complete flip. Now what Tom is saying here is that we have a rotation because people are starting to see this, and they have started to trim their biggest winners, companies like Invideo that flew up out of the stratosphere. Looking across the entire Mag 7, you'd see a similar process, but that's not the only thing that happened. We have something that might be even more influential on why this is happening right now and why Tom Lee is right about this. What we have right now is a very important change in the monetary policy of the Central Bank of the United States, the Federal Reserve. So as of February of 2022, we had 0.8% interest. That's virtually zero. Until August of 2023, very rapidly, we went up to 5.25% interest. That's a quick spike. That's aggressive. And as you would expect, the smaller companies, the small caps, the IWM index went down from 240 at the end of 2021 to 190 by August of 2023. So at the same time, the Federal Reserve spiked interest from 0 to 5.25, the IWM lost 21% of its value. Just for comparison, the S&P 500 at the same time lost 100 points, which is 2%. So as you can see, the IWM has done 10 times worse because of interest rate spike versus the S&P 500. And what Tom Lee is saying is now the opposite process has to happen. Now, I'm not going to leave you with that. I'm going to explain the mechanics of why so you can better judge what Tom Lee is saying and make up your own mind. I want you to be the thinking investor, not the guy who does something because Tom Lee said so. So the first reason that smaller companies are so much more sensitive to interest rates in either direction, good or bad, is because of valuations. And by the way, this is something we teach on our academy. We teach people how to do valuations, how to do discounted cash flow valuations of companies. One of the many ways to value companies. Now, this is probably the most prominent way to look at what's the intrinsic value of a company. But it comes down to one simple thing, which is look at what the future cash flows of the company for the next 10, 20, 30 years, and then see what these future cash flows are worth in today's values, in present value. Now, to give an example how it works, let's say that I owe you $1,000, but that's due in a year from now. And then you have to decide how much money would you take today to give up on that $1,000 in a year from now. So how much money would you take today to make it go away? So let's say that the interest rate in the market is 10%, just for the example. Well, in that case, you take 900, right? You take 900, you put it in the bank, you get 10%. In a year, you have $1,000. So $900 is the present value of $1,000 in a year with a 10% interest environment. But let's say that the Federal Reserve drops rates. Well, all of a sudden, the interest rate drop basically creates a lower discount rate, which means that now if I put $900 in the bank, I'm not getting $1,000 in a year. I'm getting much less. So now I need more. So basically now the present value of future potential of companies is much, much higher today than it was before interest rates went down. And because the market basically prices in today the future developments, and now we know the market already prices in 95% odds of 3 rate cuts this year, this has to be reflected. And because small caps, the IWM, the Russell companies, the smaller companies, mostly have their potential in the future, they're not really huge right now, we know that they're super sensitive to this because the valuations, as the interest rates drop, the valuation will climb. So that's explanation number one, why the Russell is super, super sensitive to interest rates. But there's another reason it might be just as important, if not even more important, which is operational reasons. You see, smaller companies need more borrowed money, more debt. They don't have the cash reserves and the cash flow of the big behemoth companies like Microsoft and Nvidia. They rely on borrowing money from the bank. But if they borrow money, then the interest rate is cutting away at the profits. But if the Federal Reserve reduces the interest rate, well, they can borrow more money and their bottom line looks much better because they're not spending as much on interest expenses. So the small caps, the one that rely on borrowing way more than the Magnificent Seven, they do better when you have the interest rates drop, especially if they lagged and were completely ignored by the market for 18 months. So what Tom Lee is saying is very simple. He's saying, look, guys, if we get 3 rate cuts this year, which is currently priced in at 95% chances of happening, that will make the spike in the IWM in the small caps inevitable. But there's a little kink here you need to understand. This only happens if we don't hit a recession. If we hit a recession, it's a completely whole new enchilada in which the whole rule set is a completely different thing. But if we don't hit a recession and we get interest rate reductions, then what Tom Lee is predicting for the small caps is 100% on point. Especially if you look at the macro environment right now, and what you see is low unemployment at 4%, you see GDP growth better than expected at 2.8%, and you're seeing inflation at 3%, which is way closer to normal than we were just 2 years or 3 years ago. So inflation is getting better, unemployment is steady, and GDP is very nice. So the setup right now is good macro, interest rate reductions. When you have this combination of good macro, interest rate reductions, that leads to a good economy, not to recession. And if that's the case, small caps will be the prime beneficiary of this. And if you look at statistics and history, he's right on point. Statistically speaking, small caps over the 12 months after the first rate cut by the Fed have run up historically, statistically, 26.6% in a year, which is very close to what Tom Lee is predicting. Now, he's a little bit more bullish, as he always is, but look, for the past 18 months, he's been spot on. Talk to me numbers, right? Tom Lee is saying it's going to run up. How much? Well, in the video, he clearly said that, but if you missed it, I'm going to repeat.
40% over 10 weeks?
Yeah, the overlap is small caps are very sensitive to a Fed cut. And really the probability of a Fed cut, that it's finally happening. And I think it's going to look like the October to December 2023 rally, which was almost 30%.
If he is right about this, we're talking about a melt-up of epic proportions, but not only in the small caps. And this is the one thing I want you guys to understand. It's not just about the small caps. Every single company loves cheap money. If money becomes cheaper, everybody enjoys. What Tom Lee is saying is that because there's a lag, it's going to bounce back with the rubber band effect much harder and much more violently upwards than the rest of the market. So he's not saying sell the S&P 500, sell the tech stocks, sell the AI stocks, and buy IWM. That's not what he's saying. He's saying that ignored asset class is so lagging that its catch-up over the next month, 3 months, 4 months, 5 months is going to be much more violent upwards than the rest of the market. It still doesn't mean that the S&P 500 is going to go down. That's not what he's saying. Now, I want you to listen to this clip by Steve Eisman. He's one of the big short guys. Listen to it, and then we'll talk about it because it has to do with everything I just said right now. Check it out.
Rotations are always violent. They always catch everybody unawares, and it's not a fundamental correction. It's like a psychological rotation. People all of a sudden woke up to the fact, like, I want to own something else for a while. I just don't trade. I'm not particularly good at it. God bless people who are. I just like to hold stocks for a long time. So I don't think fundamentals have really changed all that much. I mean, the only negative data point I would point to is consumer spending seems to have slowed a little bit on the margin, and delinquencies are up a touch, but nothing. And probably the economy has slowed a little bit, but I don't particularly find it any of that alarming. I mean, on sell-offs, if they're big enough, we probably would add. Let me give you a data point that tells me that we are so early in this AI story, it's hard to even tell. You have major companies that are not even in a position to do anything with an AI because their data is not yet clean and in one spot.
And he's 100% on point. This is a guy who's been through everything, telling you, hey, don't time the market. Please don't time the market. The other thing he's saying is that buy and hold is the perfect way to make money long term. Think about it. If you're buying and holding, like he's saying, the only variable you have is that you picked a good business. As long as your due diligence process is good, as long as you picked a good business, time becomes your best friend in the market. Because a good business, the stock will always catch up with the fundamentals, always, eventually. Now, he's also saying this is not a fundamental rotation. What he's saying here is basically this is not about to change the S&P 500 and spike a whole different asset class. This is an adjustment. And that adjustment is going to add another asset class to the party, which is the small caps, the IWM. It's not going to go and take the S&P 500 and put in the toilet. That's not what he's saying. He's also talking about AI being absolutely in the early stages. This is not the top, and people who are calling top on tech and AI are idiots. He's saying, look, guys, we're not even scratching the surface of this thing. This is just super early. And he's saying, look, there's no recession coming. Look at the data. The macro is fine. There's definitely pockets of problems, but nothing recessionary. Now, my 2 cents about what he said are very simple. Number one, I agree, but I want to add one more thing here, which is super important that I didn't hear him say. Corrections are healthy. If you would like to see a long, elongated, you got it? A long bull cycle, 2-3 year bull cycle, 4-year bull cycle. Corrections are important. They prevent the market from overextending too fast. So corrections keep long-term the bullish cycle. So you want to see small corrections like this. They're very healthy. They should be celebrated. Number two, I want to explain this again and I want to emphasize this again. This rotation is not mutually exclusive. The S&P 500 is not going to go to the toilet. You have a lot of money on the sideline, a lot of money that was parked there 18 months ago by people who bet the market is going to go down, people who try to time the market. They've been locked out of the market playing a game of chicken for the past 18 months, losing every single day. And they are running out of time because at the end of the year, they're going to have a lot of explaining to do. So they have to jump in today, tomorrow, in the month, but they have to do it right now. They're not going to jump into the extended S&P 500, which has run up like crazy, especially when the IWM did nothing for the past 18 months and it is set up for the perfect spike with interest rate reductions. So most of that parked money that's going to leave the money market accounts, some of that $6 trillion is mainly going to flow to these small caps. And that's going to fuel the small caps and not going to cause a collapse of the S&P 500. That's not what we're saying here. Now, there's literally discord.gg/NomNash, free to join, 15,000 smart investors talking about these things every day, massive amounts of value, no charge, no upsell, 100% free. And on top of it, if you'd like to do your own due diligence and analyze stocks and know what's shit or what's legit, I've built Stock MVP for you. It will literally run a DCF for you with a click of a button. It will tell you what insiders are buying and selling, what analysts are saying, what the stock looks like with a very simple interface. We've built it for normal people like you and I. Try it out. 7 days for free trial. No problem at all. I'll see you in the next one. Stock-mp.com. Try it out. So, what in the world happened yesterday? What was that? Why it felt so painful? More than we're used to in red days. But more importantly, how this collapse we've seen yesterday can lead to a massive opportunity to make a lot of money for smart investors. So before we go through that, I would like to take 5 seconds of your time to talk about something personal. A story about how I started on YouTube. And by the end of the story, you'll see how it connects to what I'm talking about here. Now, some of you know this, some of you may not know this, but as an immigrant kid, I came to the US. I never imagined of reaching the highs I've reached, which is working for a financial institution of the highest degree, a degree from the University of Michigan, one of the best schools in the world, working for 10 years as a senior manager for Deloitte. I mean, I had a terrific opportunity to experience the financial system up close. And for a Russian kid, that was incredible. And when I got burned out, and I knew I was burnt out, I was already financially comfortable. I was smart with my money. I'm not a huge spender. I had plenty. For my lifestyle, I had enough. So I didn't really need a job. But I decided to do YouTube because it seemed like fun, like a side project. It was COVID. I was bored. And I dove into the world of financial online media. And I was shocked. Look, I thought I was surrounded by sharks and nasty people when I worked in investment banking, when I worked for Deloitte. I thought I saw some backstabbing, some craziness. But this is absolutely nothing compares to what financial mainstream media and financial social media is doing to its own viewers. This whole thing dwarfs whatever I've seen in the actual financial industry by eons. Look, allow me to explain. This, what we've seen yesterday, is a correction. And corrections happen all the time. We'll talk about that in a second. But the level of insanity that mainstream media has drawn from this, the level of fear, panic, the level of anxiousness, oh my God, the world is ending YouTube videos from financial influencers. This has gone to a whole new level. And I'm going to step in here and I'm going to use the same tactics they use, the clickbait, to get you to watch a video that contradicts everything you hear about this. So yes, this video is titled probably something like, the world is ending 2024. I get it. Because otherwise you don't click. But now that I got you here, please listen because I'm about to say something that is completely contrarian to everything you hear on mainstream media and social media. I'm going to save some people from horrendous, horrible decisions out of emotional anxiousness. And I'm going to do that by explaining what happened, why it feels worse than it really is, and how you can use that to make money. So I'm going to do my good to counteract the BS you're seeing on YouTube and mainstream media right now. So let's talk about it. Now, what I do on this channel ultimately is help everyday people like you, like me, I'm not different than you, to get to financial success through investing. Now, the problem here is that there's a lot of emotional distractions that interfere with that goal I have. And my goal is for all of you to make money. But you have to understand that there's a lot of sharks in the water. On the one hand, Wall Street wants you to panic and they want you to get excited. They want you to buy at the top and they want you to sell at the bottom. And they want to keep doing it every time so they can make money, so they can have their Porsches and the Ferraris and the Lambos. Now, look, I don't drive a Porsche, not a Ferrari, not a Lambo. I drive a 5-year-old beat-up car and I'm happy with it. I don't need that. But they are there to get you. For them, you're pigs. Pigs being led to the slaughter and they are the wolves. And the main culprit to what they're doing, and it's important to understand that, is mainstream media. Mainstream media is in full cahoots with those people. Not officially, I mean, they don't have a deal to screw you over, but there's a clear understanding that what mainstream media does is create panic when stocks drop so they can get clicks and add revenue, money, and attention. That way pushing the agenda of Wall Street to buy cheap, and when the stocks hit the top, they push euphoria. Again, for you to click, they make the ad revenue, Wall Street sells. And they repeat that cycle every few years. There's new people that join the market every few years, and they do it to them again. New suckers, new victims. Now, I'm going to counteract this whole thing with one simple video, and today it's going to be very, very simple. Now look, unlike this media noise you're hearing right now, Unlike the end of the world YouTube thumbnails, which actually have end of the world YouTube videos, not like my clickbait. The YouTube, oh my God, this is the apocalypse, this is over, and all this crap. This is a market correction. A market correction is way more common than you think. And smart investors use market corrections to make money. And after this video is over, you probably will be able to do the same, should you choose to do so. So over the past week, we have seen the S&P 500 drop 3.2%. No, Tesla is down 14%. CrowdStrike is down almost 30%. We got TSMC down 9%, Google down 5%, Nvidia is down 6%, Palantir, my love, is down 6.5%. So the markets are currently on the pullback, on a correction. Now, allow me to explain. A 3.2% drop in the S&P 500 is not even the definition of a correction. A correction is a 10% correction. That happens every other year, according to the statistics we have in front of us. In the past 20 years, half the time, 10 out of 20 years, had a 10% correction on the S&P 500. So every other year, the S&P 500 drops 10%. It's normal. Now, what's not normal is that didn't happen since 2022, not in 2023, and not this year. We still didn't have a 10% correction. So what's the outlier here is not the correction, it's the fact that it took 18 months, and we still don't have it. We still are only on the 3.2% correction right now. Even if you measure from the peak to the trough, and you go and you measured it, and I'm going to show you right now. Let's measure from the peak to the trough. So S&P 500 at the peak, right, was at 567, right? That's on my notes. July 16th. That's the peak. Right now, with 4,500. That's a 4% drop. Even if you go and you stretch it out and you measure peak to trough, not the last week, it's down 4%. So we're not even in correction territory yet. So this is nothing. I know some of you have joined the market for the past 6 months and you think this is a correction. It's not. Now, the other thing I want to show you here is history and data, not emotions and gut feelings. When you have gut feelings, go to the toilet. Look, the S&P 500 over the past 96 years until the end of 2023. Let's use the end of 2023 as a cutoff date. So we're not going to do this mid-year, right? So if you measure 10 years in those 100 years, from whatever point you want, so 10-year increments, after 1 year, after 2 years, after 3 years, after 4 years, and in 100-year era, well, 96 to be honest. So there's a lot of 10-year periods in those 100 years. You know the crazy part about it? 96% of the time, those 10-year periods, whatever you place them on the 100-year spectrum, 96% of the time, you'll have a profitable year in the S&P 500. 96% of the time, a decade inside the S&P 500 for the past 100 years is positive. Now, you can debate all you want about the index funds being dangerous, but a 96% on a 10-year investment is not a dangerous thing. You can't tell me that. Now, the average S&P 500 return for the past 20 years is 9.5%, which is normal. We all know this by heart, right? 10% S&P 500, fine. But if I take out the best 10 days for the past 20 years, so basically I remove 10 days in 20 years, the best 10 days, I pick and choose and I remove them, that return drops from 9.5% to 5.3%. By removing only 10 days in which you're not going to be in the market for whatever reason, your return drops from 9.5 to 5.3 by half, Eddie. I want half, Eddie. Half. 10 days in 20 years. The crazier part, if I remove 20 days, if I move on average a day per year, and I just choose the best days, that return drops from 9.5% to 2.6%. If I remove 30 days, the 30 best days in 20 years, you make 0.4% in 20 years. Congratulations. But why did yesterday felt harder and more painful than regular red days we've seen for the past few months? Because we did have red days, right? But this one felt extra. Why? Well, number one, the S&P 500 dropped 2% on a single day. That hasn't happened since February of 2023. Number two, the NASDAQ dropped by 4.6% on a single day, which is very painful. And if you measure peak to trough, July 10th, which was the peak for the NASDAQ, was 500. We're down 8% from that. That is very painful. Now, the MAX 7 dropped 5.6%. It's a lot. That doesn't happen a lot. The last time these stocks dropped more than 5% in a single day was in 2022, a long time ago. Before that, 2020. This is not a common thing. So we did have a strong correction, 100%, 100%. So now the question is, what should you do? We understand what happened. We understand why it felt way more painful than the usual common red day. But what do you do now? How do you make money off of this? Well, let's use facts over emotions, shall we? Okay. So look at my portfolio. From January of 2023 until yesterday, I was up 160%. 160%. My portfolio is extremely simple. Palantir 40%, S&P 500 40%, Tesla 20%. I was up 160% on my portfolio in 18 months. Now, if you look at the videos I've done on the channel since January of 2023 until now, in the past 18 months, I have covered 9 stocks, all of which got a bullish rating from me. Now, those 9 stocks are Google, Tesla, Palantir, CrowdStrike, Bungie, SoFi, ANET, SMCI, and Nvidia. All of these stocks were green. All of these stocks were green. Not a single one was in the red. The average return was 123%. So not as good as my portfolio, but 123% in 18 months, that's some good content right there. Even the S&P 500 on its own did 41% in 18 months. The NASDAQ did even better, 80% as of January 2023. So if you measure this on a monthly basis, for the past 18 months, the S&P 500 gave you 2.2% per month nonstop, and the NASDAQ gave you 4% per month nonstop. That is literally double than the normal for a year and a half straight nonstop. Now, do you think that lasts forever? Do you think this can continue into eternity without corrections, without pullbacks? I mean, the market doesn't work like that. If you joined 6 months ago, it sure seems like it, but it's not how things work. If you have 18 months of insanity, it's going to end up with a correction, with a pullback. It's healthy, it's normal. It happens all the time. Now, look at a stock like SMCI. And this is the point where I want to make here, that you should watch these videos. I make them for fun, but they have a lot of value. Look, when I spoke about SMCI for the first time, back in August of 2023, and I said, look, this stock at $253 is insanely undervalued. In fact, the title of the video was, I'm buying this over Nvidia. Now, obviously I wasn't wrong. So the stock climbed all the way to $1,200 from $253. That's 374% in 6 months of profit. Now, what did you do with this profit? Now, once you do 374% in 6 months, it's kind of obvious that you're in a parabolic euphoric spike and it's not going to last forever. That is why in March of 2024, at about $1,000 per share, not at the top, I don't time the market, but when this thing hit $1,000, which is 4 times more than my initial video, I was like, guys, this thing ran its course. I literally posted a video in March of 2024, go back and check me saying, hey, is it a good idea to buy SMCI at $1,000? And in that video, and you'll see a clip in a second, I said very straightforward things. Check it out. This company actually builds the servers that house the Nvidia AI chips. The same AI chips the entire market is going gaga over. Well, these chips have to go into certain servers. These guys build the servers. That's why I like the correlation to Nvidia stock back in August. But at some point, because they don't really have a moat, at some point, somebody can come along and build similar servers at cheaper. It's a huge problem you have to be aware of. It's a massive, massive risk. That's why I think this company is not the next Nvidia. They don't have the know-how, the IP, and the protections and the moat of Nvidia. That's not the next ASML. You have to be very, very careful. Don't be confused. Don't go all in at one price point. Don't get excited and buy into a parabolic spike. That's not how you do it. Wait for some weakness before starting opening a position. As you just heard, I told you, this ain't Nvidia. Don't buy into a parabolic spike. Wait for weakness to open the position and make sure you understand that these guys have no moat, which means they're not the next Nvidia. There's a lot of risks there. I gave you a warning at $1,000 saying, hey, this thing is running up way too hot. Now, whether you sold it or kept it or bought it, it's your business. But on this channel, you got a warning. This is literally like the Kenny Rogers song. You gotta know when to hold them and when to fold them. And something runs up 400% in 6 months, it's probably a good idea to start thinking about taking profits. I literally told you this in the video. I gave you a warning. Now, at this point, this is water under the bridge. It's in the past. Who cares? Now, we're talking about a whole new enchilada, a whole new situation. Right now, SMCI stock, same stock that was trading at $1,200 when I made my video telling you, hey, be careful. Now it's trading at $700, which is a 40% discount from the peak. Now, it gets interesting again. This stock right now, if you want to be a part of it, if you wanted to DCA into SMCI, and it's your decision and your analysis, but if you like the stock, this is a better stock at $700 than it was at $1,200. So instead of FOMOing into a parabolic spike, wait until weakness and start dollar cost averaging into the stock, just like you can do here with SMCI. Now look, I'm not telling you to buy or sell. This ain't financial advice, for the love of God, understand that. But I'm using this as an example to show you how FOMO and emotions can work both ways. And look, if you don't want to get rattled by a day like yesterday, you gotta have a plan. You have to understand what are your goals, where you're trying to get, so you don't get mad, you don't get anxious, and you don't panic. If you're a trader, right, it's probably not a great environment for you right now, right? You have to think about stop losses. You have to think about, letting go of some of the losers to manage your portfolio. Traders is one thing, and this is a very volatile time for them. Probably not the best day to be a trader if you had long positions. But if you're a long-term investor, if what you do is invest for the next 10, 15, 20 years, this is a kid in the video game store situation, because right now you have so many options to dollar cost average and open new positions or reduce the cost on your existing positions on such great companies. This is a bad time to be a trader, but a really, really good time to be a long-term investor. We'll talk about one specific stock in a second, which I really like out of this list. But let me show you, right? Tesla is now 10% cheaper. I got it in my portfolio. I'm not going to reanalyze Tesla for the 1,000th time, right? Palantir is down 6.5%. Nvidia, the entire Max 7 is down. The S&P 500, the index, if you want to get in the index, that's down like 4%. The Nasdaq is now 8% lower than the peak. TSMC and ASML, the two leaders of semiconductors, are way, way cheaper, like 10% cheaper. CrowdStrike is now down 30% in just a few days. So let's take a look at CrowdStrike as an example of how you can make money because of sentiment, circumstance, and days like yesterday. Now look, CrowdStrike is a stock we've been covering here since 2021 for a long time. It ain't new. In fact, from my previous video until now, despite the 30% drop, it is still up 70%. Now, this company has absolutely a whirlwind of issues to deal with right now. Hearings, lawsuits, compensations, 100%. Is it a career ender for this company? Is this a company-ending cataclysmic event? Hell to the no. It's not going to happen. Sure, they take some damage, but this thing is far from being in danger of closing or shutting down or losing their dominance in the market. Look at their numbers. The company had 35% increase in revenue the past year, 186% increase in net income. It has 5 times more cash than debt. I'm looking at this and saying, so the stock dropped 30%, where the entire business is exponentially doing better than the year before. And it's already a global leader, almost a quasi-monopolistic leader in its industry. Think about it. If CrowdStrike wasn't a monopoly, would a little software update from CrowdStrike shut down 70% of the Western Hemisphere? You have to understand how big this company really is, what's the magnitude of what they do, given how insane of a result one little software update had. They'll get out of it. So my price target, based on the 5-year model, is in the bear case, $614. That's a 140% increase. $750 in the mid case, which is a 190% increase. And $886 in the bull case, which is a 243% from today's $258 price tag. Today, because of all the negative sentiment of CrowdStrike and the negative sentiment in the market, everything creates the perfect opportunity where this company, which has always been trading at a premium, is now 30% cheaper despite having some of the best fundamentals in the market. That's a money-making opportunity. Thank you. I'll see you in the next one.
And that's why, in my opinion, ultimately you'll see the ultimate outcome, which is probably honestly a 70%, 75% correction in Nvidia over the next couple of years.
You know what? Let's address some of the hater comments. One of the comments is you're early on your shorts, the timing is wrong, but you're still sticking to it. Your conviction is high. How do you respond to that?
Yeah, so they're absolutely correct. So definitely early on it. I think that's part of being, a trader, investor. You see the future and you start positioning yourself ahead. Just a good analogy, or actually a good point. I had some people that I was trading money for back in 07. I warned them in early to mid 07 to be exiting the market in full. We didn't start to decline until early 08, and so I was about 6 to 8 months early there. I'm probably 6 to 8 months early here as well.
Gareth Soloway returns. He is the chief market strategist at verifiedinvesting.com, and we'll be getting his monthly updates. Welcome back to the show, Gareth.
Hey, thanks so much, David. It's always great for me to be here. I love our conversations.
Yeah, I love when you're back. Lots to discuss this. Last time you're on, I want to start by talking about this divergence that's been happening between the S&P 500 sectors and the broader index since last time you were on. Since the beginning of June, Gareth, you can see that of the 10 sectors of the S&P, 8 of them have been diverging away from the S&P 500. I was telling you offline, the tech sector is the only sector year to date that's been beating the S&P. All the other sectors have lagged. In particular, the last month, you can see this really big divergence away from the main sector. I guess it's mainly driven by tech. What's your read on this? As a trader, what do you do when all the other sectors break away from the main index and the only sector that's kind of leading the pack and outperforming is tech?
Yeah, and this is something that's very concerning. I'm going to show this screen here, this chart. This is the equal weight S&P versus the S&P itself. And what's so concerning here, and you just brought it up, is that we have the S&P, which is up 14.35% year to date. The equal weight is up only 3.42. And what this tells us is that there's this massive divergence occurring where the mega caps, the Microsofts, the Apples, the Nvidias have really just taken over control. They've dominated to the point. And what this is telling us is that so many of the other companies in the S&P are actually down. Like, think about this. If you just throw those tech names, those semiconductors, those big names like Microsoft and Apple in this, if you took those out, the S&P would be here at 3.42% or even lower, maybe even negative for the year. And what that tells us is that all the money flow is going into these names, and it puts the market at extreme risk. And historically, when you see this, it is not good news for the next 6 to 12 months.
Can you just maybe make the argument that let's just overweight tech, close your eyes and go away? I've seen those in my comments in some of my videos, right? I mean, if it's the market leader, why not just stay with the leader? That's one argument.
Well, and that's the key, right? Is you could say, let's do that. And a lot of people are choosing to do that. Remember, the bigger these companies get, the more dominant in the S&P. When you put $1 in the S&P now, basically you have 6 companies that are eating up 35 cents of that dollar. And so when you're talking about these ETFs that track the S&P, money just keeps flowing in because if people are putting them into these ETFs, these tracking ETFs of the S&P, it's going into these names. And what it does is it overweights. But the problem is this. If you go back to 1999, you saw the same thing happening. And what happened to the NASDAQ? It dropped, 65% when we saw the tech bubble collapse. And so when you rely on too many of these companies, number one, it tells us that the underlying economy has a lot of problems. And number two, there's always a reversion trade at some point where people get too greedy. And then at some point, the fear comes in on these names. And that's what I do worry is going to happen.
Okay, another way to look at it is perhaps overweight some of the underperforming sectors right now because they're undervalued, perhaps on a relative valuation basis, or overweight something like the Russell 2000, which has been lagging behind the large caps. What do you think?
Yeah, I think that's one way to do it. In the very least, it's the redistribution, right? It's selling some of the money. I mean, if you have an over allocation now in certain stocks because of their massive gains, you want to kind of pare that back and maybe distribute it through some of the other names. Like there's some really high value names like a Zoom Video Communication Tech. We're using it right now. And if you look at the forward PE, it's trading at a 10 PE. And then you look at some of the other names out there like a Microsoft or Nvidia, and you're in the 30s to 40 plus PE ratio. And again, the key is if the growth rate of those names continues, awesome. Then they're going to continue to lead. The problem is, will Nvidia continually grow by X amount that it's been growing? And we know the law of large numbers, right? I mean, Cisco Systems was a great example of this. They were the main builder of the internet back in 99, 2000. They have never reached those former highs. And I do worry that we're in the same repetitive kind of signature here that we're in with Nvidia.
Before we continue with the video, I'd like to tell you about the precious metal sector. Now, gold, as you know, hit record highs in 2024. So the question on everybody's minds is, let's take a look at Nvidia now before we talk about the economy and the other asset classes. Nvidia has reached a new all-time high not too long ago and has been retracing ever since. It has at one point very briefly surpassed all the other companies to become the most valuable company in the world, ahead of Apple, Microsoft, and pretty much everything else. And then after that, it's down about 13% or 14% depending on the day. So let's take a look at the charts for Nvidia and what you see there.
Yeah, so flipping to Nvidia right here, we see that number one, we got a reversal candle on the daily chart. And this is a powerful signal where you gap higher, you make a new all-time high, and you actually close sharply lower on the day. We then had follow through for 2 consecutive days. And essentially what has happened now is you're making what's called a bear flag. Now, just to take you back to history, and we always like to do this, and this is what verified investing and myself are all about. I'm all about data, right? Well, if we look back at the previous move, this was an up move on Nvidia. We got the same gap up and reversal day. We kind of chopped sideways, and then we had as much as a 20% correction before the latest run began. And so these candle formations, these reversal candles here, which we had here for a 20% correction, you have to take them seriously when they come in on a technical analysis basis. So I'm in the camp that, listen, everyone expects the world from Nvidia, just like they did for Cisco in 1999 and 2000. And the problem is that other companies are already starting to develop chips. Now, does Nvidia have a huge advantage right now? Yes, but that advantage will narrow over time. Eventually, it did for Cisco Systems, and ultimately, we know what happened there. And by the way, one other amazing stat is when a company is the biggest market cap company in the US, like Cisco was in 1999, 2000, it got as far as 80% above its 200 moving average. Nvidia just surpassed that 100% above its 200 moving average when it was the biggest company in the stock market. That, again, to me, is a warning sign on a technical analysis basis.
Okay, but why are we comparing Cisco with Nvidia? They're different companies, different business models, different products.
Good point. So the reason you compare them is because manias are manias. Whether it's the solar mania in 07 that saw first solar rocket up 1,000%, or whether it's Cisco in 1999, or whether it's the 3D. Remember the 3D printing stocks? I don't know about if you were watching back then, David, but they had this insane run and then they collapsed back down. And so human nature doesn't change. This is why GameStop runs on hype and then gets crushed back down. Greed and fear rule the markets. And so it almost has less to do with the technology, right? The technology of AI, you could compare it to the internet, right? It's going to change our lives. It's going to be monumental, and it will be, but it doesn't stop the mania from taking things up. Bitcoin at 69,000 was a mania. It corrected to 15,000. So manias are based off of human nature. It's actually why psychology and investing and trading is so important. And that's why, in my opinion, ultimately you'll see the ultimate outcome, which is probably honestly a 70%, 75% correction in Nvidia over the next couple of years.
That's assuming that the fundamentals don't hold up and the company doesn't continue to outperform with its earnings and everything else.
Well, and the question is, this is the one thing I would just say about that is, like, people need to use common sense. They've gotten way out of whack here because it's a mania. And it's like, okay, they absolutely are crushing it right now, and they will probably crush it for the next 3-6 months. But the key is, are literally no competitors going to ever compete with them? And the answer is, of course, other competitors will. And are margins going to stay at 77% when they can sell a chip for $30,000 or $40,000? You telling me margins are going to remain at 77% like they have the last few quarters? The answer is no, not even close. And that's assuming that we don't see slowdowns in data centers, right? I mean, the economy is clearly weakening at this point. All of these are just things that common sense tells us, but people don't want to believe them right now.
Didn't Sam Altman just create a new version of ChatGPT whereby it's intelligent enough to come up with a business model? And I think he made a presentation.
So sort of amorphous, but it is a business. So I'm just wondering, like, eventually is the idea kind of like licensed technologies? Will you have customers that you're going to be customizing algorithms for them, or how's it going to work?
You know, the honest answer is we have no idea. We have never made any revenue. We have no current plans to make revenue. We have no idea how we may one day generate revenue. We have made a soft promise to investors that once we build this sort of generally intelligent system, basically we will ask it to figure out a way to generate an investment return for you. It sounds like an episode of Silicon Valley. It really does. I get it. You can laugh. It's all right.
I pray it's that easy for all of us. If we can just be like, hey, AI, make a good business, run it for me, I'll sit back myself and never trade again. I'll just let the AI trade for me.
We don't want that now, Gary. We want you to be trading for us and helping us with some guidance here. Speaking of guidance, all right, thank you for that Nvidia take. Let's talk about the economy now. What are some of the major data releases you're looking forward to this week?
Yeah, so number one is tomorrow morning, Tuesday morning at 9:30 a.m. Jerome Powell speaks. That's going to be looked at as a cue for what these job numbers are going to tell us. He probably already has the jobs numbers. Is he going to be hawkish? Is he going to be a little dovish? That speech will be a big deal. And then the next report that I'm looking for is 10 o'clock in the morning on Tuesday. That's the JOLTS numbers, job openings data. And that number will be very important. We've seen it really start to come in precipitously here, down to I think about 8 million job openings from 12 million in 2022. Now, historically, that's still above where we were in 2007 before the financial crisis. But if the number comes below 8 million, you now start to get into a reasonable longer term zone where then you can start to say, okay, it's not that easy for people to find jobs. And by the way, just some on the ground analysis. I've talked to people. I have people that I've been talking to that are looking for jobs, and they said they've applied, at least here in Florida, to literally 20, 30, 40, 50 jobs, and they're not even getting callbacks. So things are slowing here. There's no doubt about it.
What about the last month? Apparently the economy added something like 272,000 jobs, more than expected. However, at the same time, the unemployment rate also ticked up. What's your read on the economy adding more jobs, but also more people getting laid off or losing their jobs, which is leaving the labor force, thus adding to the unemployment rate at the same time?
Yeah, so I would encourage people to start looking into the underlying what jobs are being added, because I think they're lower income and they're part-time. And so this is something that the media is not talking about out there. You're awesome enough to kind of bring it to the forefront and let me express it to people. But if you look at the government continues to hire. That's been one of the major driving forces for the economy in terms of adding jobs. And then if you look at full-time work versus part-time work has been going sky high in terms of adding jobs, but full-time jobs are actually in decline. And so these are all precursors. If you look at any of the past, recession periods, this is all a precursor to a recession, to a big slowdown. And I think Jerome Powell's very aware of that, but he can't give an inch right now because you have a scenario where the stock market's at all-time highs and inflation is still north of 3%. So he has to toe the line. He has to play it the hardball way. But ultimately, they're very aware that things are slowing very quickly. They just can't say the pivot very quickly here. And by the way, I even worry about deflation. I even think I was in the camp for the longest time that we come down to 3% and kind of hold it there. But I actually think that we're in a position now where we could actually be seeing deflation. And you can only go as far as, just go simply as far as looking at some of these charts. I don't know if you looked at like the wheat chart recently or the nickel chart, but some of these charts are just downright scary. Let me bring up the nickel chart for you guys. The decline on nickel just in the last 6 weeks, 21%. If we look at other things, oil's holding up, but I heard there was a lot of shorts on the institutional side that are covering, so I think that's part of it. But then if we go to the wheat chart, these charts have just come crashing down, and I do worry that we're actually in for a deflationary period starting not until probably 2025. But if you take the stock market down 20% plus these commodities, I think you're looking at deflation.
I've heard a lot of people tell me that, well, the U.S. debt level is rising, the deficit level is projected to also increase per the Congressional Budget Office, CBO, and thus the inflation rate will eventually pick back up at some point in the future. This is more of a longer term trend. I just like to evaluate this and see if you agree or disagree with the notion that just because we have a lot of debt, inflation will not go away.
No, yeah. So this is the kicker. This is how I see it, is that you do have pockets of deflation. My biggest concern, and this is something that it keeps me up at night thinking about, is that you have a government that doesn't know how to rein in spending, and you have a Federal Reserve that every crisis looks for a reason why they can drop interest rates dramatically to stimulate the economy, and also adds literally trillions of dollars to their balance sheet. And so any sort of deflation is going to give the green light, unfortunately, to these entities to just go back printing. And this is how you get to the Max Payne level, where the debt of the U.S. literally will cause a major, even potentially hyperinflation scenario in the future. Now I'm gaming this out. This is my job, right? Is I'm a trader. I look at what's happening today, but I also look at what's happening next month, next year, next decade. And I do worry that if we do see deflation, it's going to be the trigger for all of these entities to say, oh, look, we have deflation. Let's just print more money. And that ultimately makes our bed that we're going to have to lay in down the line.
You know what's crazy? If you go to the New York Fed website and you look at the probability of U.S. recession predicted by Treasury spread, I'll put this on the screen for my viewers, but you can do it yourself if you're watching this. Just look at probability of U.S. recession in New York Fed. It's at 52%. Now, it was at 70% last year, but it's at above 50% for more than a year now. That is the highest level since 1981. That is much higher than 2007. It's much higher than 2008. I just find it bizarre that during 2008, when we had a big recession, the probability of recession as indicated by this particular Treasury spread by the New York Fed was only 50%, or actually no, 40%. So technically speaking, we are at a much higher chance of a recession than even before, and it's just not happening.
Yeah,
right.
I know you're right about it, but the thing is, and this can be argued, and I think probably some of your other guests have talked about this, is that one of the reasons why the recession has taken so long to come, and it will come, folks. I'm telling you right now, it is going to come. In fact, I'll argue in a second why I think about half, if not 2/3 of the country is already in recession. But basically, what you have is a scenario where the Fed has tightened economic policy quite a bit, but they haven't really gone away. In 2023 of March, they created a lending program for banks that were failing, which was basically unlimited amounts of funds if you were a bank that was at risk of failing. More money into the system. Banks said, hey, listen, yes, this was an emergency lending program, but we don't have to have an emergency to use this money, so let's use it and make money off of it, push it into the system. In addition, you have scenarios where the government, you can argue that the government spending has been negating some of the Fed fiscal responsibility or pullbacks on things like again, monetary policy and so forth. So these kind of combinations have made it longer in terms of coming, but it will come. And I want to show you this, David. This freaks me out here. I know this is something I wrote about this weekend, and this is a headline on verifiedinvesting.com. A shocking 401k plan saw a 40% increase in the last 12 months of hardship withdrawals. Now, again, does that sound like the economy's great when it's jumping 40%? And in fact, from 2021, it's up 100%. That's hardship withdrawals, folks. You don't want to be going into your 401k unless you absolutely have to. The reason people were going into it, the majority reason, was because they needed to save their house from going into foreclosure. Again, if the economy's so great and everyone's making a lot of money, I'm not sure where that comes about. Another stat here, and I have a chart of this, is 90-day delinquencies on credit cards are now higher than they were pre-2008. All right. Again, this is, by the way, as of the last quarter, not as of Friday, this previous second quarter end. So I expect that number to be up even more. And so the problem is you're getting a scenario where the economy has diverged. You have the wealthy that have lots of investments or money that are in, essentially, let's say, savings plans making 5%. If you have $1 billion making 5%, you're doing just fine. If you have $1 billion in the market, you're doing just fine. Even if you have a few million, you're probably doing fine. But the thing is, that's only a small percentage of the U.S. Everyone else is already struggling to get by with inflation and obviously the cost of housing. So things are tough out there right now. And it's again, this is the scenario that all you need is a stock market to correct, let's say 15 or 20%. And that top consumer, the ones that have investments, they're going to pull back. They've been keeping this economy going for the time being. They will pull back on spending and we'll be in a full-fledged recession.
I got a few counter arguments. That first, you were traveling this weekend. Honestly, now, based on your personal observation, does it feel like a recession out there?
Well, if you're in Vegas in the bubble, no, you're right. It doesn't.
Okay.
It was packed in Vegas. I was in Vegas, right? But I will say this is that if you go to other places, and by the way, I will mention this, is the grumblings in Vegas were there. All right. So people were still spending because they're on vacation, right? They're getting away. They're saying, hey, I'm here for 3 days. That's what I did. I was there for 3 days. Let's get a cabana. Let's do this. Let's have a good time. But was I shocked when a burger and fries that basically was one grade up from McDonald's at some of these hotels was $35? That's insane. And it's certainly, I have the money, but it wasn't like I was happily paying it. It was ridiculous. Now someone else that has less money, that's hard. That's ridiculous.
Okay. I'd like to know where you were staying at, where the burger was only one step up from McDonald's.
I was at MGM Grand, but
that's a nice hotel. Okay,
that's true. And listen, but that's the casino. That's the strip right there. And it's the prices were insane.
Check this out. The TSA checkpoint travel numbers. I'm pulling this up. June 30th, 2.8 million. It's up from last year. Every single day this year since basically, I'm just going back to as many quarters as I can this year. It seems to be doing better than last year. More travel activity, more volume of people at the TSA checkpoint. I don't know if they're traveling for leisure or business, but either way, travel is picking up. Is that an indicator of anything to you?
Well, so number one, you could say, okay, yes, the travel numbers are picking up, but then why in the latest quarter did Expedia, and I have the chart here, Expedia literally collapsed 20-30% on earnings. It has rallied back, but now it's starting to turn back down. So travel companies where they're booking vacations, and this might be to your point, maybe it's more business travel that's going on here because a lot of the travel websites are actually seeing a slowdown here. So great point, and you're making a good point, is that travel, you're right, airline travel is doing relatively well, but the question is it being done for business travel? Is it because people are back at work and having to travel for business versus staying home, or is it actually because people are taking more vacations? I'm not seeing the more vacation side of things.
Okay, so how are you positioned then in anticipation of your economic outlook right now?
Yeah, so there's no doubt I'm actually heavily short the markets right now. I do have some longs out there because I think you have to stay diversified. I actually am loving Baidu right now as a long trade. Now, granted, it's a China name, so you got to be a little bit on the careful side. But if we look at this chart, it's been pounded down. I mean, this is basically the Google of China from what I know, and it's trading at almost 52-week multi-year lows down here. And it's just tagged this nice little level of support down here. So I think there are pockets. I still like the Brazil markets. It's corrected decently down. I think you have a lot of black swan potential. The dollar yen is one of the biggest ones, David. So I don't know if you've covered this in depth, but look at the dollar yen just broke out above the previous high right here. This is where the Japanese central bank intervened. So they intervened and pushed it down. Then the U.S. comes out and says, hey, they're potentially going to be labeled a currency manipulator because the U.S. doesn't want to do this. And just for your viewers, everyone needs to understand that the reason why the U.S. doesn't want Japan to intervene in the currency markets is because to intervene and strengthen the yen, they have to dump dollars on the open market and they have to dump U.S. debt. They're the biggest holder of U.S. debt. If you have more U.S. debt on the open market, it pushes interest rates up, and that can work against the Federal Reserve in the future. So either way, it looks like they might have to intervene again, though, if it continues up like this.
I'm happy you brought up the yen. Let's keep that screen up there. I heard somebody told me last week the fair value should be 140. Just take a look at the charts. Is that possible?
It certainly is at some point, but certainly, I mean, right now the trend is definitely strong here. You've broken above, so you have a breakout above the previous high. I have a target for my intervention where I do think that they'll be forced to intervene. See the high end of the channel right up here. So if we look, every time it hits here, you get a big sell-off. Right here, you got the intervention. So I think if you get up to this level here, which is right around 163 and change, I think the Japanese central bank will be forced to intervene. And then it'll be interesting to watch how that is a kind of how does the U.S. react to that intervention, because they basically warned Japan not to do it. And then, by the way, not to mention other geopolitical issues, but what's going on in France, we've seen the CAC actually have a breakdown here. I'm going to bring up the CAC chart. And by the way, I don't look at other markets that often, China and stuff like that. But look at the rollover from this high here on the CAC. The CAC is down significantly, basically 10% off of its highs. And the DAX, which is arguably the more important market in Germany, actually broke a wedge pattern. It's making a bear flag. So that implies further downside to come in Europe, in the European Union here. So there's a lot of things that are hanging out there, including Taiwan, Russia, posing up to China, and then to North Korea. But people continue to say just buy the market, and that's been working up until now. I just do caution people that this was the mentality in previous scenarios before big declines.
The other currencies, though, the euro. Let's just take a look at one more currency pair. Yep. The euro versus the dollar. It looks like the dollar has been strengthening versus the euro all throughout the year, despite the fact that the Fed has kept rates. Well, I think that's probably why, right? The Fed has kept rates high, and the euro area has just cut rates. So
right, and I think
interest rate,
exactly.
This interest rate differential is that going to eventually weigh down the Fed and make them think, look, it's time to do something about this, or do they not care about the currency?
No, they do. They will eventually. In fact, it almost gives them the green flag. If everyone else is cutting rates around you, it kind of gives you the green flag that you can potentially do that as well. And I do think that's one of the driving forces. You have Canada cutting rates, the EU cutting rates. You do have what we call in technical analysis a classic wedge pattern on the euro dollar here. And I would just say that in general, watch for which way this breaks out. So when you get wedge patterns, essentially it's hard to know which direction they will go. But once they break, they usually get a big move in that direction. So you would basically watch for a breakout or a breakdown, and then watch out in that direction for a big move.
Let's talk about Bitcoin now. Bitcoin has it's just been range bound ever since it broke above $74,000 not too long ago, and then now it's at 62. So it's between 62 and 70,000. This range has been going on for a couple months now. Is it going to break out anytime soon, do you think?
So I still expect a little bit more weakness, but I am a mid to long term bull. I think again, the more I see what's going on with the government and the kind of catastrophic spending that shows literally no side wants to get control of it at this point, and then you look at what the Fed is about to do in terms of lowering interest rates. I do think eventually more and more people adopt the idea that Bitcoin is that digital source of safety. Now it's not right now, but one of the positives about Bitcoin is that the volatility has gone down dramatically. Now, if you're an investor who likes seeing 30% moves in a week, you're not so happy. But if you're someone who looks for a asset like gold, but maybe in digital form, I do think this brings up a great opportunity for a kind of a longer term play. Now, again, my only concern here is that we clearly see the stock market have still an influence on Bitcoin, meaning that if we still see this correction that I do see coming in the stock market, then Bitcoin probably goes down, at least in the short term. I do have a big level at 50,000 right here. This is the former spot ETF approval high, major technical support, downsloping trend line kind of right here. So I think I would start accumulating there, but I have to also be fully aware that if we do get into a full-fledged recession and the Fed does cut rates. Now, by the way, just to interject here, everyone says, oh, when the Fed cuts rates, the markets will go higher. Actually, historically, it's the opposite. When the Fed starts cutting, actually, is when the markets start going lower. So just be aware that if the stock market does roll over 10, 15, 20%, we're likely headed to 50 and maybe even down lower than that. So the basics, just to summarize, I'm a buyer on weakness of Bitcoin because I'm a long-term bull, but I do expect it to get weaker and give me those buying opportunities.
If the Fed cuts rates into a weak economy, that could be bearish for the stock markets. But
right.
Let's just for the sake of argument, assume there's a soft landing and nothing happens and they still cut rates. Would that still be bad for stocks?
So my guess is if we have a soft landing, the only thing you get is one or two cuts, and the market will eventually not like that per valuation metrics. I mean, I think the market's already factoring in excessive cuts at this point. And also, again, I would just bring up the former data we looked at in terms of delinquencies, in terms of hardship loans from 401ks or borrowing from 401ks, is that to me, it clearly shows that probably the one thing keeping the economy afloat right now is the stock market. And I do worry that once that has any sort of, even a 10% correction, I think a lot of people would pull back on their spending to have exposure to the stock market because they get worried.
In terms of timing then, are you tactically long for now? Like, would you stay, let's say, riding the momentum for now until you see even more signs the economy is turning south?
So for me, I'm a leader in terms of I want to get in front of a move. So I've already shorted the NASDAQ. Like I said, I do have some longs, a little Baidu, a little Zoom, a little, there are pockets where I want to be diversified and have some long exposure. But I do want to just mention here, this is the chart of the NASDAQ 100. And look at this channel. This is again, just like we're looking at, remember, we're just looking at a chart of the dollar yen had a channel. Channels are really powerful and they're not used in technical analysis often, but they work. And here's the low from 2020 connected to the low of the recession or the bear market in 2022. And if we stretch a parallel up to this high, the high from the bull market of 2021, we actually just tagged this high here. And to me, that would insinuate some sort of drop. Now, is it a small drop of 3 to 5%? We don't know, but ultimately I would expect a pullback here. And in addition, the daily chart put in a top topping tail last Friday. Topping tails are bearish reversal signals. So it's another signal that could tell us we're on the verge of a pullback. Last thing I'll mention, David, is that the last time we corrected here, this little correction going back to April, it was when, and this is kind of wild, it was when we saw a blackout period for companies just ahead of earnings where they couldn't buy their own stock back. And so here we are, literally we just entered a period now where we're in this blackout period. About 50+% of the S&P is now in a blackout period. They can't do share buybacks. And again, notice the coordination here. When companies don't buy their stock back, the stock market doesn't do so well. And it's another reason we could see at least a 3 to 5% correction, and we'll have to see if it expands into more.
If Nvidia corrects by even 50%, not even 70%, wouldn't that take down the rest of the market?
Oh, 100%. I mean, it's taking the market up. And by the way, just so everyone's aware here, I just want to show the thesis behind it. So now listen, you can argue that AI is different than the internet bubble. You could argue that, there's all these different narratives. But what I want to show you here is on Tesla. If you go back to the Tesla highs in 2021, what did we do here? Let's do a measurement. So if we look at the decline, we saw a 75% decline in Tesla before it stabilized off of that bubble high. Now you can say, okay, well, that's just Tesla. Okay, well, let's go to Cisco Systems and let's go to the monthly Cisco Systems chart and let's go back here to the chart here of Cisco in the .com era. What did it drop? Let's do a quick drop down here. Basically, you dropped about 85%. Okay, well, that's just one more. Let's go to First Solar. Let's go to the First Solar bubble in 2007 here. What did it drop? 74%, right? So there's this coordination where tends to see these type of corrections when something gets out of favor. Now, do I think that Nvidia at a 75% discount is a great buy? Yeah, I actually do. Because what happens is at highs, things get overdone because of greed, and then fear takes over at the lows, and they probably shouldn't be down that much. So they'll be buying opportunities. But remember, this doesn't happen overnight either. And I think this is important. A lot of people, they watch these, they're like, oh, Garrett's predicting like in the next month. No, not at all. It literally will take a year to year and a half. It's about an 18-month cycle. If you look from the high here on the monthly to the low, you're probably talking about 12 to 18 months. But I do think once you start that correction, you'll see Nvidia correct sizably.
Let's finish off with gold then. Well, gold and the dollar. Let's do gold and the dollar. They're kind of linked. The gold price has been, again, trading range bound, just like Bitcoin. But obviously different magnitude. So what's your take there on this trading pattern?
Yeah, so the pattern itself right now is favoring the downside in the short term, but continues to be consolidation in the long term. So I talked about this in December with you. We talked about a gold breakout. It happened, beautiful move to 2,400 and change. But now you're in this what we would call consolidation period. And essentially what we've had is this is a topping tail. We pulled back, we pierced it, never closed above. I expect us to eventually break this 2280 level and at least come down to about 2190. 2190 starts to get interesting. I think is a buying opportunity, but I do expect a little bit of weakness before the next leg takes us probably to 2,800, maybe even $3,000 an ounce. So I continue to be hugely bullish long term because I think again the fiscal issues facing this country and facing the world are a nightmare that isn't going to be easily fixed. And gold is one of the answers, and eventually Bitcoin will be the other answer.
And then the dollar, we talked about other currency pairs, but the DXY just continues to hang in there despite what may appear to be a weakening economy. And I've heard this from actually economists who are bullish. They say the economy is slowing, not necessarily flat out collapsing, but just slowing. Anyway, the dollar is holding strong. What's your take?
So the first thing to remember is the US dollar doesn't have as much to do with the economy here as what's going on with other currencies, right? So the fact that the yen is weakening, the fact that the euro is kind of stabilized, but again, the dollar's holding up. A lot of other currencies, because these central banks are cutting rates, their currencies are weakening, which is keeping the dollar stronger. If the US starts cutting rates aggressively, then the dollar, you would assume, would start to fall. But right now, remember, the dollar is against all a basket of currencies, and those currencies are weaker, and that's keeping the dollar strong. On a technical analysis basis, we have a very clear potential breakout, but it's not yet done. Above 106.20 would be a breakout. That could actually take us as high as 114. On the other side, if we break 104, you're likely going to about 101 to 102. So again, this is kind of a range bound. You can see it's just up, down, up. Let's watch to see which way it breaks. I eventually think the dollar does weaken, but again, it's a basket of currency. So if everyone weakens more than us, it'll keep the dollar relatively strong. The US dollar is still the cleanest piece of laundry in a dirty hamper, if you will, or whatever analogy you want to use.
Plenty of more things to discuss next time, but we're out of time to take care of. I wish I could talk to you all day.
Oh man, there's so much to talk about. There's so much to talk about.
Where can we find you? Actually, you know what? Let's address some of the hater comments. One of the comments is you're early on your shorts, the timing is wrong, but you're still sticking to it. Your conviction is high. How do you respond to that?
Yeah, so the absolutely correct. So definitely early on it. I think that's part of being, a trader, investor. You see the future and you start positioning yourself ahead. Just a good analogy, or actually a good point. I had some people that I was trading money for back in 07. I warned them in early to mid 07 to be exiting the market in full. We didn't start to decline until early 08, and so I was about 6 to 8 months early there. I'm probably 6 to 8 months early here as well. But ultimately, what is the writing on the wall is there for everyone. I mean, that's the thing. Is like you can't deny it. We can kind of put our head in the sand, but it's going to happen. And it's better. I'd rather miss some upside than be caught with my pants down on the downside.
Why don't you just stay out of the markets, like just cash?
Yeah, I'm a trader though. You know how I am. I'm a swing trader. I'm in and out so much. I mean, again, do I have a lot of longer term positions? No, but ultimately I think that it's good to be positioned. Like look at Michael Burry, right? He positioned himself ahead of it and he ended up making so much money when what he predicted occurred in 08. I'd rather be in that position and really make the big money at that point as well.
It's a good, we'll finish off here. It's a good example of Michael Burry because he had to pay a lot in basically credit default swap premiums before the whole thing collapsed. And so his investors were like, dude, what are you doing? Get rid of this. Like you're losing money for us. Yep. And he held on to it, right? And he turned out to be right.
It's not easy, David. I'll say this. It's not easy going against the group and the masses, but you ultimately, if you know what you're doing and you're reading the charts and the data correctly, you ultimately will be right. Michael Burry, great example there.
Okay. Do you stop losses right now?
Yeah. So on certain things, if it's a bigger macro play, then I'm just letting it do its thing. That's fine with me. I don't mind allowing it to breathe a little bit. But if it's a shorter term trade, absolutely.
Okay. Where can we find you? Now you're all over the place, but what's a good place to find your work?
VerifiedInvesting.com. It's a place where we're data driven. It's all about charts and data analysis. We have lots of other traders joining this website. All the homepage has amazing content on there for free. Heat maps and earnings and economic data and chart analysis, all free. And then we have courses where we teach people how to trade, trading room for day trading and swing trade setups as well. So it's really meant to be a place where I want to draw the best in the world. And that's one of the reasons why I love interviewing with you. You are one of the best in the world, David. And I'm sure your comments people will agree with you on that.
We make a good show. So I appreciate you coming on the program. Next time we'll talk about more stuff. I got to go, but thanks for being here.
The market is not oversold yet. We think that this correction continues.
This is a problem that we're seeing. We don't have a consistent message coming from the earnings season. That's what's causing some of this volatility.
While there could be some stumbling, we are maintaining our overweight recommendation on tech.
There's likely this disconnect that's building between the earnings expectations and what's happening in the economy.
Ultimately, the fundamentals matter, and I think the fundamentals support this rotation.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern. Let's get your trading week started. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance begins right now with your equity market looking a little something like this. Equity futures on the S&P 500 positive by 0.3%, leaving behind 2 weeks of losses on the S&P 500, 3 weeks of losses on the Nasdaq 100, and 3 weeks of gains on the Russell. That rotation continues. We'll pick up on the small caps. Talk about a busy week. Central bank triple header, tons of economic data, payrolls on Friday, and lots of earnings from mega cap tech. A wonderful job of going through the week ahead. The data, the earnings, the central bank decisions. If you could pick one right now, what would you like to know this morning?
I think earnings are important. I think that's, for the most part, the communication policy from the central banks, especially the Fed, are, pretty robust these days. So, Wednesday will come and go, and there really won't be that many surprises. But given how volatile these earnings have created an environment in the market, they're important.
Something for everyone in the earnings over the last few weeks, for both the bulls and the bears alike. I think the one question we've asked on this program repeatedly over the last month or so is worth repeating again this morning. Are things cooling or heading in a bad direction? Which one is it?
I think things are still fine, to be honest with you. Like the wheat and the chaff when it comes to earnings is like you've got earnings and then you've got really the valuation around them. The earnings have not been terrible. Granted, maybe the market got ahead of itself. Certainly valuations, practically everyone has been talking about how frothy they've gotten. But the story around earnings, the story around U.S. exceptionalism because of these companies is still retained in my mind.
Well, this again goes to this question of can the Fed give some sort of concrete message, or is it basically going to be a very neutral one that truly leaves open the fact that Friday and the next payrolls report that we get before the next Fed meeting will be pivotal in making the decision? Essentially, this is going to hinge on 1 or 2 data points about whether they go in September or not.
Every data point is live. They've been telling us that, and for sure, the data remains mixed. There have been signs of a slowing in the economy, for sure, and the markets have gotten excited about that. But GDP shows that the retail consumer is still engaged when you kind of look at those big components.
All right, so let's put the Fed aside, or raise this question to you. Which is more important, the Bank of Japan or the Fed, to potentially disrupt this market?
The Fed still. I mean, certainly if you're trading dollar yen, you're going to say that the BOJ is the most important thing to think about. But really, the Fed is going to set the tone for everybody else. And our view is that while the BOJ certainly needs to start to normalize policy, they don't have really that many levers to work with. I mean, they're dealing with 30 years of unconventional monetary policy that they're slowly trying to unwind. And I think that's why we keep talking about them in this waiting period, because it's that hard for them.
Okay, so here's the issue. John's going to laugh at me, but I kind of have to go here. I'm sorry, John. I think that a lot of people think that I'm overly obsessed with
Is this Treasury refunding?
Maybe.
Okay.
So
I'm a rich guy. So I appreciate that.
I know. So
ready to go.
Okay, this is important, right? I mean, this could potentially be the market moving almost more so than a lot of the other potential events. I mean, arguably, this could be as important as earnings, no?
QRA this month and this quarter is not going to be the most important aspect. We're not going to get a whole lot of changes, but really thinking through how this cycle is going to wind up and who's going to wind up buying all these treasuries is going to be the most important thing that we really think about. Because if the BOJ is buying less treasuries, less JGBs, somebody else has to buy them. And if those buyers are treasury buyers at the moment, when we kind of think through this going into 2025, you have to ask your question: who's going to wind up picking up this increase in treasury issuance, which really starts to ramp up in the middle of next year?
Smells like bear steepening in 2025. Is that what it is for you?
Yeah.
So that goes against the grain at the moment, because what we've seen over the last week is the bull steepness, or a big rally at the front end of the curve last week. Why do you take a different perspective on this?
Well, number one, rate cutting cycles have a massive tailwind for everything. They're that important. So, the natural gravitation to go long duration during rate cutting cycles is something, just don't fight. But when we had the volatility last Wednesday and we had long yields going higher, you really needed to ask your question. You really need to ask the question: is the relationships that exist between duration and risk what it used to be? And I really do see a number of things from the perspective of the BOJ, whether or not they force less treasury buyers to kind of come out of the market, whether or not you talk about debt sustainability, whether you talk about a new inflation paradigm, for instance, where housing is no longer as stable as it used to be, because it's going to take a long time for this housing market to stabilize, and that has an impact on inflation volatility.
What you're saying will have huge consequences for asset allocation.
Yes.
Are you suggesting that in 2025 treasuries won't have risk mitigation characteristics in a drawdown in equities?
I think that you've seen that for the better part of this year, and you've been able to ignore it because rate cuts are that important to the story. But once we get to either the midpoint or the end of that story, you really ask yourself, where are they at the end, and how much of it do I want to own?
So what is the risk mitigation? Is it still the dollar? Is it Bitcoin, given the recent conference we've heard from the former President Trump?
Yeah, I'm not a crypto advocate, so I'll kind of stay off of that. I think equity allocations themselves have the potential to be much higher, but currencies also, certainly from a perspective that we haven't seen before.
Marvin, before you go, give me a 10-year yield target for next year. What kind of numbers are you and the team thinking about?
I think 5.25 is something that we should think about.
Back to 5.25 on a 10-year. Is that politically independent or politically dependent?
It is politically independent from a perspective that both parties are bad actors in Washington.
Okay, Marvin Lowe of State Street. Marvin, good to see you.
Thank you.
Quite a call on the 10-year for next year. Equity futures, if you are just joining us, welcome to the program. Big week ahead. We're positive by a third of 1% on the S&P 500 with an update on stories elsewhere with your Bloomberg brief. It's Danny Berger. Hey, Danny.
Hey, John. Nicolas Maduro has been declared the winner in Venezuela's presidential election by the electoral authority, which is overseen by the ruling regime. The opposition is rejecting that claim. It called on the military to enforce what it said was the will of the people. The U.S. and some Latin American neighbors have also raised concerns. U.S.
Quality of life is higher. The economies are better.
Have you received vetting materials from the Harris campaign?
Wednesday, the Fed decides.
You said summers were quiet. I don't remember the last quiet summer.
We're talking about the data not being as accurate during this time of year, an election that's haywire.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Is the answer here, Jeff, that everything is just plain solid?
It's pretty solid, Tom.
At some point, we got to call it a soft landing.
Tune in to Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
Live from New York City, welcome to the program. Good morning to you all. A brand new trading week ahead of us. Equity futures right now positive by about 0.4%. That's the bounce. Yields a little bit lower by 3 basis points, almost 4. We're down to 415.89 on a 10-year. Under surveillance this morning, ramping up the search for a running mate.
The fact of the matter is, where you see the policies that Vice President Harris was a part of making, Democratic governors across the country executed those policies, and quality of life is higher, the economies are better.
Have you received vetting materials from the Harris campaign?
Well, I'm not speaking on anything personal on this. I think being mentioned is certainly an honor. My job is to make sure that, and I trust that Vice President Harris' judgment, she'll make the best choice she's going to. But one way or another, she is going to win in November.
Here's the latest this morning. Bloomberg reporting presumptive Democratic nominee Kamala Harris is down to 3 potential running mates: Senator Mark Kelly of Arizona, Governor Josh Shapiro of Pennsylvania, and Governor Tim Walz of Minnesota. The latest polling from ABC News showing an 8 percentage point jump in favorability for Harris over the last week. Terry Haynes of Pangea Policy giving Harris a 60% chance to win the White House, owing to 3 things: strict discipline from Harris on messaging, serious Democratic turnout, and a VP pick that broadens the ticket's appeal to independent voters. Terry Haynes of Pangea Policy joined us now for more. Terry, it was your base case when Biden was running that he'd edge this, and it seems like even more so now with Harris, this is your base case that Harris edges this. What is it about Harris that makes this race much more winnable for the Democrats than it did under, say, Biden?
I think there's really 3 things. There's firstly, there's enthusiasm within the Democratic base. Democrats are already coming home, and I think they've come home to stay. Secondly, the social issue platform really appeals a lot to independents. I think a lot of the economic messages are frankly baked in. But what you got is, you got a situation where, this was already in place, where you're going to scare people about their freedoms, and that's the catchphrase of the catchword of the Harris campaign already is freedom. And you're going to do that, and then you're going to play into Trump fatigue as well. And finally, I think there's just what I called in the piece the thrill of the new. When we've always talked about double haters and how much people didn't want this race to happen, and all of a sudden there's a big alternative and a generational alternative, and I think that plays into it as well.
Terry, even when, just to John's point, even when Biden was still running, you really didn't think that Donald Trump was going to win. You thought that either way, you would have Biden eke out some sort of victory. Why is it, and what can you point to, that there's actual Trump fatigue at a time where he really has managed to increase his donations, has garnered a lot of big sort of corporate backing? What gives you that sense that he's really running out of steam?
Well, I think a lot of what you mentioned, including the fundraising, is pretty transactional. What I've looked for all year is very simple. Trump's base does not equal the Republican Party, for example, and you saw that in the primaries, where 20 to 40% of people were voting for somebody other than Trump, mostly Haley. But does he consolidate the Republican Party? Does he unify it? And can he appeal to the majority of independents? That was the winning formula in 2016. That was the losing formula in 2020. So far, that formula isn't filled out in the way that Trump needs in order to become president. He's still got splits in the party, I think, number one. Number two, the vice presidential pick doesn't help with that. That's not transformational. That's small ball, which in turn makes it much more difficult for him to actually appeal to independents in the way that I think Harris and a centrist VP pick is likely to.
Is there going to be a September debate, Terry?
I think, I would say so. I'll give you 80% that there is. Sure. If they're haggling about which network it's going to be on, they both said yes, and that's the bottom line.
Terry, how do you think the message changes from the Trump campaign?
I think they're struggling for that right now. I think they try to double down in a way that isn't personally insulting to Harris on her lack of experience and all the rest. They move a little bit more. Trump will move a little bit more presidential. Kind of, I've been there. I've seen it. I know what to do. He never talks about how he'll do it, of course, but I know what to do. They will exploit Harris's lack of experience in foreign policy. They'll denigrate the border. They'll hammer much more on economic messages and, frankly, border messages, and make the point that the administration of which the vice president is part, made the country markedly worse. So it'll be a little bit of shift in tone, but not a shift in messages itself.
We've seen plenty of twists and changes in this election race in the last month. I wonder if we could see another one. Do you think the former president sticks with his running mate, Terry?
Oh yeah, I do. I think that pie's already baked. But there's a lot of regret there already. As I said within an hour after it happened, it's a mistake because it's political small ball, and it doesn't expand Trump's appeal, and that's really come home just in the last week or two. And that'll get emphasized even further with a pick of the kind that you've already talked about in the intro.
Can we talk about Bitcoin, Terry? Can we talk about crypto? It wasn't on my bingo card that suddenly this crypto conference was going to be sort of a massive rally for Donald Trump. Really, I was really struck Friday by this crypto conference where Trump raised a lot of money. He talked about the importance of crypto assets and being on the technological forefront of all of the new developments. Do you understand kind of what this message is geared at, whether it's just a fundraising tool or whether it's something more substantial?
I think it's primarily a fundraising tool, and it's a way to continue to generate enthusiasm among kind of Silicon Valley backers. And if you think about crypto and Bitcoin and the like as kind of an adjunct to tech, which it is, it looks that way, sure. But fundamentally, I think the enthusiasm is overblown. All these folks have been looking for 4 years for a horse to ride ever since they thought they were the grooviest people in Washington in 2020, and then they couldn't make anything happen at all, and the administration was obviously hostile to what they wanted. So now what you see is a lot of sentiment saying, oh well, this will be the crypto president, this will be this, that, and the other. The path forward there is much murkier. The institutional folks who want to defend the sovereign currency, I think, are a bigger obstacle than Trump believes.
Well, to that point, Terry, is there any connection to sort of focus on weakening the dollar, on Donald Trump saying that the dollar is too strong, and the support of crypto assets?
Well, I think that's a very valid point. And my view of Trump generally is that if he was a painter, he'd be Jackson Pollock. If he'd be but if he was a cook, he'd be throwing the spaghetti.
Peter Schiff has pointed to the geopolitical risks at a time where there are a lot of question marks about how continuous leadership is going to be in the world's biggest economy.
Oh, big question marks about US leadership. Things are fragile, really, really fragile in that part of the world. I want to turn to this story, going into Apple earnings later on this week. People familiar with the matter telling Bloomberg that Apple's upcoming AI upgrades will be delayed. New features now being released in October after software overhauls for the iPhone and iPad in September. Early testing for developers will still happen as soon as this week. To put this in sort of plain English, Lisa, are we saying that the iPhone comes out in September, but without the good stuff coming from AI?
Yeah, and when you say the good stuff, it is really the main story of what the iPhone 16 has to offer. Our own Mark Gurman has already reported that other than the AI changes, the iPhone 16 line doesn't really have much by way of design difference from the previous iterations. It's leaned entirely on really artificial intelligence upgrades, other than just having a faster chip and a different way of controlling the camera.
So the point you're alluding to is basically all the bullish calls out there. Dan Ives, Wed Bush has made this call repeatedly that we'll get this big upgrade cycle. When we finally get this big evolution of the iPhone, that's going to be delayed?
Essentially, yes. I mean, one could make the argument that if they're delaying it to make sure it's perfect, which has been Apple's tradition, right? That basically they try to hone it so that it doesn't have a huge snafu that's embarrassing. Then potentially it's not a problem if you wait an extra month. If you delay it for a month, it's not a big deal. If it's that they're having difficulty understanding what AI could potentially be deployed in a convenient way that actually is a must-have, that becomes a more sort of existential question.
That stock is just a little bit softer in pre-market trading. Later on this morning, I think the next hour or so, we'll catch up with Ed Ludlow from the West Coast, actually here on the East Coast in New York, to break down some of these issues that's taking place with Apple and looking at the earnings from everybody else. For everybody else, we'll be looking at a trio of central bank decisions on deck. The Fed and BOJ on Wednesday, the Bank of England due on Thursday. Steve Englander of Standard Chartered saying the Bank of Japan may be teeing up for a rate hike in September, saying the market will be happy enough if they give a wink and a nod. Steve joins us now for more. Steve, is that what we're looking for this week? Winks and nods for September for both the BOJ and the Federal Reserve going in opposite directions?
Exactly. One doing the left eye, the other doing the right eye. I think the Fed is going to leave the door open and sound encouraging, but they certainly don't want to sound committal. They're going to wait and make sure that the data kind of are reasonably consistent. But, it does sound as if they would like to cut in September and justify the market's views. So, with a lot of trepidation, this looks like a layup in terms of meeting market expectations and not jarring the market too much. So I wouldn't expect too much fireworks out of it. BOJ, more interesting. We don't think they're going to cut, we don't think they're going to hike. But the market only has like 12 basis points priced in for September. So if they give enough of an indication, that we just don't want to talk about tapering and do a rate hike at the same meeting, we think the market will be comfortable with it as long as they don't lowball the tapering.
So, Steve, let's take dollar yen, just short of 154. A wink and nods on both sides of that currency pair sufficient to keep this trend intact, maintain this journey back towards 150 and maybe below?
To really get it moving, they would have to hike. We don't expect that, but that's the risk. I think to keep it where it is, and given that they've upped the importance of the exchange rate, I think the kind of wink and nod that, you alluded to, I think that that's going to be enough, maybe to keep the yen sort of slightly stronger, not enormously stronger. I think for that, we would need them to show that, they are moving and that they're moving more aggressively than is now priced in.
Just to sort of underscore that, Steve, are you saying that they are not going to hike rates and that will sort of be okay for the currency market, or they're not going to hike rates and that's going to be devastating for the yen and it's going to go back to where it was versus the dollar, say, 2 weeks ago?
Look, to devastate the yen, they would have to put September in question. And I don't think that's going to happen. To sort of, but given that, if you look at the market pricing, yes, they have like 5 or 6 basis points priced in for this week, but they only have 12 in total for September. So I think if the market walks away saying, they didn't hike, we didn't really expect them to, but they're good for September, I think that's going to be fine for the yen. Like a bunt single. It's not going to be a triple or a home run.
How much does the balance sheet matter? Pantheon Macro talking about how that could placate the market if they just stop buying as many bonds. Do you agree?
Well, I think they have to, given that they sort of justified doing nothing last time by promising that they're going to lay out their path. And they do have to sort of announce a significant cut. If they, the other risk for yen weakening is if the the pace of balance sheet reduction is so slow that the market says it's not meaningful. But again, we think that they will give enough of a indication of the pace on the balance sheet, front-loaded enough that it should be all right for the yen. I think that it's going to be consistent with market expectations.
Steve, that's bond buying in Japan. It could have some implications for the kind of buying that takes place here in the United States as the supply starts to ramp up. Steve, you've seen all the articles, all the studies on the so-called activist treasury issuance. Steve, what's your understanding of what ATI actually is and how much weight do you put on it?
I think ATI is a modern version of, what was done 60 years ago in terms of Operation Twist, that you kind of reduce issuance at the long end, takes the pressure off the long end of the bond market, you issue at the short end. And that's, kind of you end up with a flatter yield curve. And you can kind of see that that's what they've been doing the last couple of years, except that they haven't been doing it the last couple of months. So it's one thing to say that they're trying to take the pressure off the long end, but given that they haven't been doing that kind of issuing this year, it's not an explanation for why 10-year bond yields are 4.15 now, down from 4.70 at the end of April. Also, I think that they overstate the impact, or some commentary overstates the impact in the sense of talking about it being equal to 100 basis points of cuts. I think that that's not quite there, because what we've seen, the experiment that's being run, even if you assume 25 basis points at the long end, is what if the long yield goes down by 25 basis points and Fed funds is held flat? It's not, let's cut Fed funds by 100, that's going to take the long end by 25, and that's going to have a big impact. I mean, intuitively, we've had the long end swing 25 basis points 4 or 5 times this year, and we haven't seen any trauma in the market. People like us have trauma, people, in asset markets worry about it, but it's not as if economic activity seems to be visibly affected by that kind of move at the long end, as long as the Fed isn't actually moving, and now the market's waiting for the Fed to move.
Well, Steve, let's flip this on its head. What if the Treasury comes out this week and says that they're much more heavily weighting the issuance going forward to the long end? How big could the reaction be in terms of yields rising on the 10-year, on the 30-year?
Well, I think the market kind of expects, them to continue in the direction that they've been going. Lately, if they do issue at the long end, a lot. I think it could matter, but I actually think it's more second order. It matters, but it's not, and it's going to matter in terms of do yields stay at where I just saw them, like 415, 417? Probably not, but it's not going to take them to 470. It's 10 basis points, 20 basis points maximum. Again, it matters, but it's a second order in terms of the economy.
Down to about 416 this morning. Steve, let's go catch up, sir. Steve Englander there of Standard Chartered. Yields down across the curve. We're down 3 or 4 basis points on a 10-year this morning. On a 2-year, down a single basis point. Your yield at the front end of the curve, about 437. With an update on stories elsewhere this morning with your Bloomberg brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. Heineken shares are lower this morning, 7.6% in the European trade. The brewing giant's first half profit growth came in weaker than analysts had expected. Beer sales were expected to grow 3.4%. Instead, they rose just 2.1%. Heineken also took a nearly $950 million charge for a decline in valuation of its stake in China's largest brewer. It also flagged that U.S. weakness is clouding its prospects. Meanwhile, Alibaba shares, the ADRs are rising by the most in 2 months, 1.5%. It announced plans to boost service fees for merchants. Alibaba will start charging a basic software service of 0.6% for the fees on confirmed transactions for vendors on the Tmall and Taobao platforms. Merchants learned of the policy change on Friday, according to a person familiar, but Alibaba may waive the new policy for small merchants, the person said. And the FT is reporting that Swiss drug maker Roche is fast-tracking its weight loss pill. The company's CEO told the FT its plans were motivated by encouraging data. It had a study that showed 6.1% reduction in weight only after 4 weeks of using the medication. Roche hopes it can get its pill to market by 2028 and compete with the lucrative drugs made by Eli Lilly and Novo Nordisk. And that's your Bloomberg Brief. John.
Danny, thank you. We'll see Danny again in about 30 minutes' time. Up next on the program, setting the stage for September.
I think rate cuts are definitely coming. I just think that at this point, there's not a really strong case for waiting. I think it's time to start to focus on the risks of the economy. It goes up by more than 0.5%.
First interest rate cut.
And saying that the economy is fine. It's sort of this huge division that we see breaking out between those who think that the economy is on the precipice of really deteriorating, others who say, did you see the GDP or did you not see the GDP that we just got?
City at the low end at about 150, and they're looking for a cut in September. The scores look like this in the equity market on the S&P 500, up by 0.4%. The bond market rally continues on a 10-year, yield to lower by 3 or 4 basis points. The 10-year down to 415.89. Under surveillance this morning, setting the stage for September.
I think rate cuts are definitely coming. I just think that at this point, there's not a really strong case for waiting. I think it's time to start to focus on the risks of the economy, the risks of the labor market, to minimize the risk of recession, which always occurs when the unemployment rate goes up by more than 0.5% on a 3-month average basis.
So here's the latest going into this big decision later this week. Investors widely expecting the Fed to hold rates steady at a meeting on Wednesday and set the stage for a September rate cut. The decision coming just 2 days ahead of another key data point, the July payrolls report. Lindsay Piegser of Stifel writing this, coupled with the Fed's assessment of cooling labor market conditions, 2 back-to-back months of improving disinflation may prove to be sufficient justification for Powell to offer the reprieve investors have been desperately awaiting. Lindsay joins us now for more. Lindsay, let's get straight to it. Wednesday, everyone expecting this baby step towards a September rate cut. What do you think that baby step looks like in that news conference Wednesday?
Well, if the Fed wants to open the door to a September rate cut, they're going to have to adjust 2 main key points in the statement. Remember, in June, they said it's not appropriate to cut rates until they have needed confidence. And they also characterized the improvement in inflation as modest. So we're going to have to see the Fed back off from that need for further confidence, suggesting that they're at that point. And they're also going to have to increase their assessment of the level of improvement in terms of disinflation. Those are going to be the 2 key points to really suggest that the Fed is gearing up for a rate reduction in September, despite all of the relatively solid data as a backdrop.
The backdrop also including a lot of warnings, Lindsay, that the labour market's about to break and they need to get ahead of it and cut interest rates at this meeting, this week, this month, in July. Do you think they start to put even more weight on the other side of the dual mandate at this meeting?
Well, they have been pretty clear. We've heard from Powell that the dual mandate, stable prices, full employment, have come into better balance. And so they are going to be focusing on both of those mandates as opposed to just reinstating price stability. But that being said, the labor market is not necessarily on the precipice of breaking. We have seen a loss of momentum. We have seen less tight-ish conditions relative to the start of the year. But we're still talking about a circa 4% unemployment rate, near 4% wage growth. We've seen non-farm payrolls, yes, with increased volatility, but an average pace of over 200,000 thus far for 2024. That's still indicative of a relatively solid labor market. So you couple that with inflation that has been stubbornly elevated, showing now only 2 consecutive months of improvement. With the core PCE stuck at 2.6%, there's very little justification for the need for a rate cut at this point, despite the fact that the Fed may in fact move forward, as this is clearly a committee desperate to provide relief.
So that's where I wanted to go with you, Lindsay. Within some of your commentary, you said the Fed is offering up, perhaps, if the data cooperates, the reprieve that investors are desperately hoping for. Do you think that if the Fed ends up cutting rates sooner than later, not necessarily this month, this week's meeting, but maybe in September, that would be a mistake really aimed at placating markets?
I do think that this is a Fed that is desperate to try and achieve that utopic soft landing. And Powell has been very clear, the committee in general has been very clear, that they understand that the risks of cutting too late may create unnecessarily large burdens for the economy, potentially leading to a downturn or an outright recession. But the committee has also recognized the risk of cutting too soon or too much, because that could allow inflation to come back. That could allow inflationary pressures to become more embedded into the U.S. economy. So when we talk about the risks, absolutely, there are risks of the Fed waiting beyond September, even waiting beyond December into 2025. But if we're talking about the risks of a potential downturn versus reinstating price stability, well, as we've heard time and time again from the Fed, without price stability, the economy doesn't work for anyone.
You know, Lindsay, we've been looking into the earnings and trying to listen to what companies are saying. We've heard from airlines that say that they can't charge consumers as much as they have in the past. We hear from auto manufacturers that the issue is just how much can they cut prices to compete, to move cars off the lots. Where are you seeing signs that there really is this sort of resurgent inflation waiting in the pipeline at a time where a lot of companies are talking about price cuts, not price hikes?
Well, I think when we're talking about price cuts, we're talking about less price acceleration. Remember, prices are still rising in most cases when we talk about broadly across sectors, but it's that lack of downward momentum that we're trying to get from a monetary policy or from a corporate standpoint, that lack of upward pressure that they have been able to instill and continue to pass on these rising prices to consumers. But again, when you're talking about the indications of resilience, let's look at the consumer. The consumer momentum actually picked up from Q1 to Q2, suggesting that there is still a good amount of borrowing power, investment power, spending power out there in the U.S. economy. And that suggests that without indications of the consumer significantly faltering, the Fed still may not have done enough to reinforce the notion of instilling price stability, not hoping for price stability with a slower pace of disinflation, but getting us back to that 2% target.
Lindsay, I'm perhaps more interested in the Fed speak after the rate decision and after the payrolls report on Friday. And I'd love your view on this. I'm not saying it's your base case. I know it's not. I just want to understand, if we triggered the SARM rule on Friday, are we going to see a bunch of Fed officials run around saying, don't worry about it, it's not about demand, it's about supply? How do you think this is going to work?
Well, I think we're going to see two different storylines from Fed officials. As we saw via the dot plot, there's this growing dichotomy between Fed officials, those that are increasingly concerned about weakness, emerging weakness in the labor market, and those that are more focused on reinstating price stability. So if, in fact, we do see a weaker than expected payrolls report on Friday and we do trigger the SARM rule, I think you're going to hear two storylines. Don't look over here, continue to focus on inflation, and those that are saying, I told you so, we need to move sooner rather than later.
Lindsay Piesa of Stifel. Lindsay, appreciate it. Appreciate the input.
Thank you.
A little bit of scenario analysis at the end there. And one individual who will be saying, look at it and make a move, and that's Andrew Holdenhorst of Citi, because he's the one guy looking for 4.2% on Friday.
Yeah, and that triggers a SARM rule. We've talked about sort of the psychological impact of that. People have differing degrees of sort of predicting how the markets are going to respond to that. Nonetheless, he's been calling for a more rapid cooling. I think the JOLTS number might be as important in some ways. We get that tomorrow, the job openings and how much they're coming down is sort of a real-time look at how much companies are adjusting their labor market needs at a time where there definitely is cooling growth.
I think you nailed it by bringing up the companies we've heard from so far. Can we get a clean read on where the consumer is at in America based on what we've heard from the airlines, the automakers, and some of the consumer-facing companies?
Absolutely not. I mean, this is the issue, is that you've seen incredible price increases in a lot of these cars. You've seen incredible price increases in some of the routes that we've seen with airlines. You see on the margins that things are maybe getting less frothy. Can we make that extrapolation, though, from this commentary that things are falling off a cliff, that people aren't traveling, that they're not buying cars? Nah, not really.
Cooling, not cooled. How many times have we heard that from the likes of Bank of America and others too? In the next hour on Bloomberg Surveillance, we'll catch up with Linda Dussel of Federated Hermes, Jeanette Lowe of Strategas, Ed Ludlow of Bloomberg, and Amanda Lynham of BlackRock. From New York City, your second hour of Bloomberg Surveillance. Up next. Triple header. You'll hear from the Bank of England, the Bank of Japan, the Federal Reserve, kicking things off on Wednesday. Look out for that. And then the earnings. Where'd you begin and where'd you end? The earnings for big tech. Microsoft tomorrow, Wednesday Meta, Thursday Apple, together with Amazon. Then you've got to wait a few weeks, wait a month. Invideo, the big players reporting this week.
Arguably, the earnings will be most important this week. Just the tech giants account for about 20% of the S&P market cap. If you take a look at all of the earnings that we get, in addition to the likes of McDonald's and others, AMD, you end up with more than 30% of the S&P 500 at a time where big tech has led the way down. Can you get a reprieve with some big beats from the four that we get this week?
Show me the money. I think that's what Manus Cranny was talking about in the last couple of days off the back of some of these tech earnings. You always get a feel a few weeks deep into earnings season what investors are willing to reward and what they're going to punish. And I think we got a flavour of that in the last week with the likes of Alphabet.
There has been this theory that you can't spend enough money on the infrastructure around artificial intelligence, and the people who spend the most on CapEx will be rewarded the most. And that died last week. We saw Alphabet actually spend more than people previously expected on CapEx, and they were punished for it, which is sort of this question of, is this something that needs to be monetized now and in excess of what investors are expecting in order to continue a rally that has been historic over the past few years, but that has absolutely hit a speed bump?
And that's the earnings. For the Federal Reserve, I sense a little bit of calm. A lot more calm relative to where we were this time a week ago. Because going into last week, there was a sense of urgency from some people, including Bill Dudley, the former New York Fed president, who wrote that piece in Bloomberg Opinion. Let's go. Then the economic data came out and just settled things down again going into Wednesday. Do you think things are pretty settled down going into Wednesday?
There is a very small chance baked into the Fed funds futures market that the Fed does anything in terms of a rate move this week. The question is going to be whether they actually tee up a September rate cut, or do they just sort of give it the data dependence flavor that allows them to do it if the data cooperates? That, I guess, is sort of the big question. So that kind of took some of the steam out because you got GDP, growing at 2.8% in the second quarter. And that really kind of threw some cold water on this idea that we were going into the tanker.
Jobless claims settled down a little bit as well. I think that was a key data point for us in the last week. We'll get another round of claims on Thursday, going into the big one on Friday. Payrolls Friday. Your economic data then, still ahead. The earnings, the central bank decisions, the scores into all of that look a little something like this. Equity futures on the S&P 500 firmer by 1/3%. In the bond market, yields are lower by 4 basis points now, 4.1550 on a 10-year. There's one thing we haven't talked about, but you'll hear a lot about it from a certain Lisa Bravitz through the week. Quarterly refunding announcement from the Treasury.
Okay, I care about this because basically today they're going to give you an estimate of how much they're going to borrow, and then on Wednesday they'll give you a sense of what type of maturities they'll sell in at a time where you're talking about ETI activist Treasury issuance issuance. You're talking about the idea that this Treasury Department is trying to weight more heavily some of the issuance on the front end to avoid causing some sort of disruption in Treasury yields. For all those people who are falling asleep, this matters because the U.S. is selling record amounts of debt. And if they sell them in longer term yields, you can imagine people will say, hey, can you pay us a little bit more to really buy all this stuff?
Just for the record, of course, I'm joking. I agree with you. A lot of people agree with you. It's an important story for later this week. We've talked a lot about a softer consumer. Certain companies just pushing back and saying, you know what, maybe we've reached the limit here. Here's another one potentially. McDonald's reporting just moments ago, Lisa, sales sliding for the first time since when?
2020.
Wow.
In the second quarter. And this comes at a time when you have same store sales falling 1%. They talk about how diners are pulling back. They are being more discretionary. We talked about the $5 meal and how they are extending it to try to attract diners in. Just to give you the number, the second quarter adjusted earnings per share came in at $2.97 versus the estimate of $3.07. There is a question of how much this is political, international. We'll dig into some of the numbers. At the same time, this is something we have seen elsewhere also, that in order to bring in some of those diners, these companies are having to create value meals of sorts that really give a value proposition that we haven't seen in quite a while.
It's a pretty telling quote from the CEO in a statement. The chain will remain focused on, quote, reliable, everyday value as diners become more discriminating with their spending. Cost-conscious consumer. Saw it from Pepsi, didn't we? Heard it from Delta and some of the airlines as well.
And you asked this question, at what point is this sort of a broader economic signal versus something that is specific to companies that have been raising their prices pretty dramatically over the past few years? How much is it a competitive edge of execution, and how much is it consumers falling off a cliff? We're walking that tightrope right now, where it seems to be on the edges. It's fine, but definitely showing that consumers are pushing back and rejecting high prices.
That wire's getting thinner and thinner. That stock is down by about 0.5% in early trading. Coming up this hour, we'll catch up with Linda Dussel of Federated Hermes as stocks gain ahead of a big week for tech earnings. Jeanette Lowe of Strategas with less than 100 days to go until the election. And Amanda Lynham of BlackRock as the Fed prepares to meet. We begin with our top story. Stocks attempting to bounce back, going into a busy week of earnings, central bank decisions and economic data. We'll get results from Microsoft, Meta, Apple and Amazon, plus interest rate decisions from the BOJ, the Fed and BOE. And we round out the week with the US payrolls report. Joining us now to discuss.
Estimated.
So is this a loss of pricing power or just poor execution? I'm struggling here, Linda. How are you framing things?
Well, it's definitely a loss of pricing power for sure. And it's been an easy road for a lot of companies in these last number of years. Yes, we've had historically high inflation, but with historically high inflation, if you can push that through, your top line looks good. And to the extent that we have lots of stimulus money, which we have had, just running out of it this year, first time this year now, then we would spend up for it. So that's why we at Federated Hermes are watching in the earnings season for what the profit margins and the outlook will be. And it's still fairly early on in the earnings season to make a decision on how that's going.
Given that the consumer is still strong in your belief, but is definitely price sensitive, and you definitely have seen a lack of pricing power from particularly companies that cater to some of the lower end, do you think that the outperformance that has been historic in small caps, in some of the other non-tech names, makes sense?
Well, small cap, was historically oversold. It had never been this inexpensive versus the S&P 500 since before the tech bubble burst. So if you look at the S&P 600, the PE ratio on a forward earnings basis is just about 17. That's 21 times for the S&P 500. They remain historically inexpensive. And what's interesting also about the small caps and where they start their move up this year, yes, it's been hard and quick, but they have never been historically so exposed in their trading to what was going on in the 10-year Treasury bond. So very, very exposed to what's been going on in interest rates. And you've just mentioned that we're at the low four handle on the 10-year right now. We at Federated Hermes think we'll be in a range of 4 to 4.5% for the time being in that area. That is a nice spot to stop for the small caps to get a breath, especially small cap growth stocks.
There probably are people watching this who are throwing things at the screen saying, really, you're going to talk about small caps before big tech when you've got the likes of Microsoft and Apple and Amazon and Meta all reporting this week. A lot of people saying it's so important, especially because of the significant reaction last week from Alphabet and Tesla. How high is the bar for some of these tech giants to really exceed and restart a rally that has really sputtered out with a true correction?
Well, I guess the bar is pretty high when you consider that the top 10 names in recent weeks represented 37% of the weight of the S&P 500 on market cap. They also represented 31% of the earnings. So you've never been that high, that's way higher than what it was before the tech bubble burst in 2000, which means that if any one of them falls off, disappoints a bit. So many of us own every one of these names. We've booked a lot of profits and we'll sell right away, notwithstanding the fact that they're probably still very, very well-heeled, lots of cash flow and probably excellent prospects going forward. That's just part of the volatility that we've been thinking you would see this summer anyway in the market. So it's just a trigger that you pull, and then you step back and you say, but now wait a minute. They are not historically as expensive, again, as we were back in 2000. And I was there when that bubble burst. It's not nearly like that. These companies are still extremely profitable. I think we'll have to remember that.
A big week ahead for earnings in corporate America. Linda, we have to leave it there. It's good to catch up. Linda Dussel there of Federated Hermes. I've got Mohammed Al-Aaron on one shoulder, just sort of whispering and now shouting, listen to the companies. So let's listen to some of the companies. Nestle, in the last week or so, there is value-seeking behavior among consumers. Pepsi, a few weeks back. In the US, there is clearly a consumer that is more challenged as Pepsi. This is McDonald's. The first slide in sales going back to 2020. They have this to say. They'll remain focused on reliable, everyday value as diners become more discriminating with their spending.
You asked the question, is this an execution question or is this a broad-based pullback by consumers? It's tricky to know the answer because on one hand, you have certain companies, Coca-Cola I can point to, that outperformed. You have certain airlines that have managed to do better than others, although albeit this is particularly difficult this time around. McDonald's in particular, there's also this issue of protests internationally, which they said is dragging on their earnings. So you start looking under the hood, and again, it's sort of, you hear that consumers are pushing back, but it's hard to extrapolate how far this will
That
go.
international story hit Starbucks as well, right?
Yeah.
It's been a similar story from those two over the last few quarters. McDonald's is up by about 0.7%, just bouncing back from early losses in the last couple of minutes or so. Equity futures positive still by 0.4%. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Another attack has occurred on France's infrastructure during the Olympic Games. This time, a number of fiber optic cables were cut overnight. The cables carry broadband services across France's southern and eastern regions. Orange, the Olympic telecom partner, said the connections into Paris and thus the Olympics were not affected. Just on Friday, coordinated fires on French rail lines had disrupted trains ahead of the opening ceremony. And President Biden will call for term limits and ethic rules for Supreme Court justices later today. It's part of a sweeping new proposal. It also calls for a constitutional amendment to ensure that former presidents can be tried for crimes committed while in office. The plan, though, faces a difficult path in Congress. Democrats have increasingly called for reforms to the court amid recent controversies, but passing those changes would require support from the GOP-controlled House. And Prada is set to open a flagship 8,000-square-foot store in Hong Kong luxury mall that, according to people familiar, construction will begin soon, and the store is expected to open early next year. It will become Prada's first major new location in Hong Kong in years. Global luxury brands have been increasingly returning to Hong Kong's business district, attracted by property prices that are trading at much lower levels than the pre-pandemic levels. And that's your brief, John.
That's certainly a demonstration of confidence there. Danny, thank you. More from Danny later on this hour in about 30 minutes' time. Up next on the program, less than 100 days to go.
That formula isn't filled out in the way that Trump needs in order to become president. He's still got splits in the party. The vice presidential pick makes it much more difficult for him to actually appeal to independents in the way that I think Harris and a centrist VP pick is likely to.
We'll continue that conversation next. That's just around the corner. This is Bloomberg.
The Fed decides.
We said summers were quiet. I don't remember the last quiet summer.
We're talking about the data not being as accurate during this time of year, an election that's haywire.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Is the answer here, Jeff, that everything is just plain solid?
It's pretty solid, Tom. At some point, we got to call it a soft landing.
Tune in.
The new iPhone is that it looks cool because you can show the gadgets and the different types of attributes to your friends. How much can AI really add on that front at this point, given where it is?
It's a really interesting story, and it puts to the question of how much faith you put into third-party data. And I say that because when Apple reports earnings, usually the opposite of what the third-party data has proved true. That said, in the first quarter of this year, there was a lot of evidence that the Chinese consumer, for example, was very satisfied with the iPhone 15 generation. You know, in surveys and the shipment data, it would indicate that they bought it, and that would be it for quite a long period of time. You wouldn't come back and buy annually a new generation of iPhone. The other interesting point of difference is that Apple Intelligence is going to be available from, I believe, the 15 hardware generation anyway, meaning you don't have to absolutely buy the 16 to get to it. Your existing handset's fine. It's all strategy from Apple, and I think that most people would say they're satisfied. You don't spend handset or hardware money to get AI tools. A lot of people in the consumer use case are going with what's free. It's a beautiful part of the Microsoft story, right? Microsoft's been really good for a really long time, even before I was born, at selling software that you could otherwise just get for free. And that's where we are right now in how humans use generative AI. I like using it, but I'm not willing to spend. And I think that's going to be a big story for the rest of the year.
You mentioned Microsoft.
Yeah.
We're going to hear from Apple this week. Maybe they'll give some more guidance on this particular front. We're also going to hear from Microsoft. We're going to hear from Meta. We're going to hear from Amazon. We've been asking this all morning. How high is the bar for them at this point, given how punished Alphabet was? Tesla's is a bit of a different story, but Alphabet for simply investing more than people had expected.
Yeah, the story across all four of the names that report this week is very simple, that no one's yet able to say clearly for every dollar you've put in, how many dollars come out. And they all have a different way of putting it. So last quarter, Microsoft said they had 31% top-line growth in cloud, and 7% of that growth came from AI sales. It's somewhat tangible, but for the market, they basically say, we expect you to invest, but we reserve the right to be disappointed if you can't give us something we understand. And that was really the story of Google last week, right? They said that year to date, they had made billions of dollars from generative AI and AI infrastructure. That's another way of saying we made money basically for the business of cloud that does both of those things, but we're not going to quantify for you specifically how much came from the generative AI side. In other words, how many dollars came out for the infrastructure investment they made, while infrastructure came in higher than the street was expecting.
If you could have any of the earnings right now, which would it be?
So the reason Alphabet was so good that it went first is that it told us everything about everything. They do cloud, but search is their core business, right? And so the street looked at it and went, hold on, I thought this was about AI, and you're telling me the thing you've always done is still your most important thing. That makes Amazon really interesting for me. AWS has a revenue run rate of $100 billion and a revenue run rate of billions in generative AI, but increasingly advertising has become important for them, and we get a gauge on the consumer. You kind of get everything, and you probably don't get that with Microsoft. Microsoft sells software. They've always sold software. They're quite good at it. You don't really learn that much from it as you might learn from Amazon.
Ed, it's good to see you. You're here all week?
I'm here all week. Thank you.
Looking forward to covering the stories with you. Ed Ludlow there from the West Coast, now on the East Coast for the next week or so to break down some of these earnings. Equity futures right now on the S&P positive by about 0.5% with an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Speaking of earnings, McDonald's shares up slightly, 0.6% in the pre-market. Sales declined for them for the first time since 2020 from international to U.S. locations. Each of McDonald's geographic footprints saw sales decline for an overall drop of 1%. The estimate was for 8.8% growth. The company's CEO said consumers were being more discriminating with their spend. McDonald's and its competitors are now offering discounts to try to lure customers back in. McDonald's latest is a $5 meal deal that it launched last month. And Chinese tech company Xiaomi has purchased a plot of land in Beijing for over $100 million to expand electric car production. The move follows the early success of its debut sedan. Xiaomi first entered the auto sector in March and has already delivered 30,000 vehicles so far. The company is on track to reach its initial goal of 100,000 cars by November. The company is perhaps better known for its smartphones, but it's also aiming to bring an SUV similar to a Tesla Model Y to market as early as next year. Disney's Deadpool and Wolverine has shattered box office records this weekend, bringing in $205 million. The buddy superhero film scored the best ever opening for an R-rated film, with more than twice the ticket sales of 2019's Joker during its first opening weekend. The latest entry in the ever-expanding Marvel Cinematic Universe continues Disney hot streak this summer after Pixar's Inside Out 2 grew almost $1.5 billion since its June release. And that's your brief. John.
Disney needed some good news. That's some good news. Thank you very much, Danny. Up next on the program, too little, too late.
I think the Fed should have been cutting earlier this year. Reason being that they've achieved their objectives. The labor market's feeling a little squishy here, and again, why take a chance? Mission accomplished. You've achieved your goals. Let's get going.
Get a move on. Fair down repeat, haven't we, over the last couple of weeks? They're not going to get a move on, based on what they've told us going into Wednesday. And that debate is up next from New York City. You're watching Bloomberg Surveillance. Equities right now on the S&P, positive by 0.4%. A little bit of a bounce, continues. Yields lower by 3 or 4 basis points. The 10-year, 4.1569. Under surveillance this morning, too little, too late.
I think the Fed should have been cutting earlier this year. Reason being that they've achieved their objectives. The counter is, well, nothing's going wrong. Well, really, you're going to wait till something goes wrong before you start cutting rates? Isn't that too late? The labor market's feeling a little squishy here, and again, why take a chance? Mission accomplished. You've achieved your goals. Let's get going.
Here's the latest. The Fed expected to set the stage for a September rate cut, when it meets this week. But some market participants are wondering if the central bank is behind the curve. Amanda Liner of BlackRock is in the September camp, and she joined us now for more. So, Amanda, we've got Moody's saying get a move on. We've got Bill Dudley saying get a move on. Mohamed El-Erian saying get a move on. What's the excuse to wait?
Good morning. Thank you for having me. I don't think there is a strong sense of urgency for the Fed to cut, given where growth is. But at the same time, we are seeing loosening in the labor market, weakening in the consumer. In addition to the earnings that you've been citing this morning, you have the Philadelphia Fed credit card data that shows consumer delinquencies on credit cards at a 12-year high. So that bifurcated low end of the consumer really is feeling the pain. And so I do think the Fed's been communicating this kind of pending rate cut for a long time. Inflation has been moving in the right direction really since April. So we certainly see the case for them to kind of tee up a rate cut in the July kind of commentary and then move forward with it in September. I think the question, though, really is what is the depth of this rate cutting cycle? So how far do they go? How much relief, for example, does that give consumers and corporate borrowers? And then also, again, the drivers behind this rate cutting cycle are really important. Are they cutting urgently in response to deteriorating growth and deterioration in the labor market, or is it really just kind of normalizing monetary policy?
This is a difficult question to answer, but just explore it with us. Where would you look for in credit to sort of discount some of these issues that might be on the horizon? Because credit spreads, Lisa and I have been going back and forth on this for the last couple of weeks. They're super tight. They say there's nothing to see here. There's no growth scale whatsoever. Is that right?
So there are some pockets of vulnerability. High yield spreads, 306, well below the post-financial crisis average. But there, in addition to the kind of well-telegraphed themes that many talk about, there's one point that I think is really important and kind of explains some of this resilience in credit spreads, and it's unique to the cycle. It's that companies are staying private for longer. They're staying in that kind of private lending ecosystem for longer. So by the time that they get to the high yield market, they're larger, more diversified companies. And I think that is a defining feature of this cycle. But to your point, Jonathan, triple Cs are showing this. They've not kept pace with the overall rally in the broader high yield market in terms of spreads. And even within triple Cs, there's a lot of bifurcation. There's some triple Cs that trade at 700 and some triple Cs that we refer to as kind of almost broken capital structures, and they trade much wider than that.
I want to dive into what you just said, which is that companies are staying private for longer. And it raises this issue, are you going to see the distress in a more pronounced way first in the private credit sphere before you see any disruption in the public markets?
It's a great question. I think the important offset is that the underwriting process in the private markets and kind of the structuring is very different than in the liquid market. So these are exposures that are held on kind of one lender or a few lenders' balance sheets. They're held in size. They're held for the maturity of the loan. I do think it's going to be difficult for new entrants in private credit that don't have kind of incumbent business models and perhaps workout expertise. So I don't think this is a rising tide lifts all boats, that all private credit lenders will be insulated. But the important thing is the growth backdrop supportive? Our view, and this is true for both liquid and private credit, is that you need either trend or above trend growth as a prerequisite for the ongoing resilience that we've seen. So that is really what we're looking for. We're not expecting material near-term interest rate relief. And so given that, you need the growth backdrop to kind of play along to keep profits and margins elevated. And they're already getting squeezed. So that's what we're watching. But just to circle back to the high yield spread comment, I think it shows that this cycle is so unique because we often look to kind of the 90s and the early 2000s. The credit markets are completely different. I think the best analogy you could make in terms of valuations and credit is mid-2021, where that was kind of the local peak for spreads, both in IG and high yield. But keep in mind that yields were much lower then. So actually, the yield-based buying that's happening today is a strong tailwind for spreads, and we're even wider than those mid-2021 levels today. And in 2021, we didn't have the yield support. So I think there's a significant opportunity cost for being materially underweight credit at the moment.
Are you saying that the credit can no longer be the canary in the coal mine? That essentially you could see a rolling over in some of the economic activity without necessarily commensurating credit spread widening just because of the good balance sheet situation?
I think the case for broad-based deterioration in corporate credit is a bit difficult. I think the bar for that is very high. Our kind of theme for the past few quarters actually has been dispersion, but not widespread market disruption. So I think really the most likely outcome is that you see these kind of canary in the coal mines in certain issuers, certain sectors, parts of the high yield market, parts of the private credit market, parts of the leveraged loan market. But broad-based deterioration I think is difficult because the cycle is just so unique. You've got technical tailwinds from most of the supply being refinancing related, so not a lot of new money, yield-based buying, a third viable option of funding in private credit, and 2.8% GDP growth. So even if we slow from here, we're probably still at trend. I think that's really the key to watch is the growth backdrop.
I just want to understand if this is what you're saying. What I hear is the spreads can remain tight for longer than you think because the all yield opportunity is just so great right now compared to where we've been previously.
Yeah, and not exclusively for that reason, but coupled with the fact that corporates entered this period from a pretty solid balance sheet position. And then, of course, you have this kind of other viable funding market in the private markets. And then also the technicals have been supportive in terms of supply. So yes, there's been a lot of supply in high yield and leveraged loans, but it's actually been skewed towards refinancing. The other thing that gives me comfort is corporates are now chipping away at late 2025, early 2026 maturities. So when you think about kind of high yield possibly widening or IG even widening, you kind of go to what's the catalyst? I think it's unlikely to be a payment catalyst because the balance sheets are in such.
So that maturity will scare of next year, survive until 25. We put that story to bed?
I think, yeah, I mean, I don't know if it's to bed for every single corporate because there are some, I would say, again, triple C, really kind of lower quality issuers that are struggling in some instances to kind of shore up and get into a sustainable capital structure. But corporates have made great progress on it, and I think appropriately so. They've capitalized on the strong tone.
And looking right now at the all-in yield for high yield bonds, it's 7.6%. It's close to what it was back in mid-2022. So it's about the lowest levels going back 2 years. If the Fed cuts rates, does that actually make financial conditions easier? Does that actually lead to lower borrowing costs for companies from here? Or are we kind of stuck here for a while, one way or another, that spreads can compensate for any decline in yields?
If the Fed cuts rates, I think what it could do is bring some of that cash out of money market funds and kind of deploy it into longer term maturities. For corporates, I think they've been appropriately issuing irrespective of the rate environment. So if we get a 25 or 50 basis point cut this year, I don't think it's game changing for high yield corporates. I don't think they suddenly rush to issue. And in fact, the commentary from some of the large banks with debt capital market syndicate operations has actually said that the activity in the first and second quarter was a pull forward from later this year, possibly to get ahead of event risk. So I actually think the calculus for corporates when they're issuing has been less about the rate environment and more about how can I shore up my balance sheet, how can I be proactive, and I think that's appropriate.
Amanda, as always, just fantastic breakdown. It's good to see you. Amanda Lannon there of BlackRock, just on the resilience of credit and the reasons for that resilience.
And this has been the reason that people have pointed to why they're not nervous that there's going to be some sort of big sell-off or some big recession. They say, look how tight credit spreads are. Well, maybe credit spreads aren't going to respond as quickly. And this is the problem, is that maybe specific credit spreads will respond, but not broad-based because there are lots of different economies that are moving at different cycles post-pandemic.
It's not the credit market of 15, 20 years ago. I think it's fair to say, right?
It's not your grandmother's credit market.
Is that how old your grandmother is? 15, 20 years older than me. Come on.
Yeah, okay. Good. I'm just saying. All right, no, I'm just saying. I know,
No.
okay, but back in...
You're aging people, okay? They were around for that. Remember that.
I was too.
Same here.
Okay.
Equity futures right now.
Thank
on the
you.
S&P, firmer by 0.4%.
How about this markets?
How about that market? In the next hour on Bloomberg Surveillance, a younger audience as everyone tunes out. Coming up, Kevin Gordon of Charles Schwab, Arun Sundaram of CFRA, James Camp of Eagle Asset Management, Zach Griffiths of Credit Sites. That's up next. This is Bloomberg.
Stocks would do if there was really a 5.25% 10-year yield.
Tell me where the economy is, and I'll tell you what stocks would do.
All right, Janet Yellen.
If we've got unemployment closer to 5 and yields are 2, we've got a big problem.
Yeah,
a big problem. Coming up this hour, we'll catch up with Kevin Gordon of Charles Schwab on why he says the great rotation will continue. No one's ever called me Janet Yellen. Arun Sundaram, that was delayed on that. We'll catch up with Arun Sundaram of CFRA as consumers start to pull back, and Zach Griffiths of Credit Sites on why the market is pricing in a dovish hold for this week's Fed meeting. I'm sorry, Janet. We begin with a big issue, the cusp of correction, a turbulent rotation out of big tech, dragging the Nasdaq down 8% in just over 2 weeks. Kevin Gordon of Charles Schwab seeing that rotation continuing, saying this: the normalization process will continue to pull up the laggards, but it won't be smooth. Much of this is now starting to take place given the recent snapback in small caps. Small caps are really just doing what they were supposed to do more than a year ago. I'm pleased to welcome Kevin to the program right now. Kevin, good morning.
Morning, guys.
It's great to see you, sir. Let's start with this. Just your framework for thinking about things at the moment. Rolling recessions, rolling recoveries. Is that how you still view things?
Yeah, it's still how we view things. And, for the most part, it's kind of kept up with how the economy has evolved this year. I mean, it's been a choppier process, though, for the recovery part. So when you think about areas of the economy that went through their own recessions, manufacturing, housing-related consumer goods in that 2022 to 2023 period, those have now started to enter recoveries, but it's been choppy. So manufacturing's been choppy because of the turn lower in some of the ISM and some of the regional Fed data. Of course, the consumer's been under, still some pressures you've all been talking about today. And then now you're starting to see it morph a little bit into services. And this is now the point where I think we really start to see, more meat on the bones as to how much the services hit is really going to take down the broader economy, or if you can get that nice kind of roll through on the manufacturing side, and it's just a softening in services, and then you kind of keep everything afloat. So to the normalization part on the market's part, I think that in our view is still that you've got these laggards that are more cyclical in nature, that are smaller in nature, that really struggled as the cyclical parts of the economy, struggled, and then now they probably have more runway to at least normalize or catch up.
So let's talk about the service industry first. Surprise for us all, I think, was the airlines. We came into this quarter, we all went to the airport, busy, went on a plane, packed, and then Delta, United, American all came out and said it's not as good as you think it is. What did you make of all the commentary we've heard from the service industry?
I think it's tough because now you're at a point for especially the labor market where things have started to soften. You've seen not only on the demand side, things start to cool, but that's morphed into now just overall aggregate income growth cooling as well. And it's not this Armageddon scenario where you have to automatically start comparing to prior recessions like the global financial crisis or even to some extent the tech bust, which in GDP terms or labor terms was not that cataclysmic. But I do think that some of the discretionary spending and the choices that consumers are starting to make and being a little bit more selective and decisive on where they put their money, that's become a bigger part of the story. But I think we also have to keep in mind, in many ways, we've been calling this year sort of a tale of two markets, but there's also been a tale of two economies, especially on the consumer side. You look at inflation within CPI for non-discretionary versus discretionary items. The non-discretionary items, that annual inflation rate is still running in the 5 to 6% range. But if you look at the discretionary items, it's basically flat. So I think because that you're now starting to see that income growth slow and consumers are having a little bit of a harder time, especially down the income spectrum, deciding where they're going to put their money, even if they're still fully employed, it's just a choice that they're making and being more selective.
You have a pretty contrarian call. You said that if we look at certain traditional metrics, we're actually in a recession.
Well, it's if something like the unemployment rate itself, one of the, I think, cycles you could look back to, not saying that this is a repeat by any means, but what's interesting to me and one of the most fascinating recessions to study is the one that was from 1973 to 75. For the first 9 months of that recession, payrolls were positive. Payroll growth was actually positive. It was decelerating, but you were still adding jobs even as the unemployment rate went up from mid 4 to mid 5%. You didn't start to get that waterfall in payrolls until the very end of that recession. So it kind of speaks to the fact that, yeah, we have seen a move up in the unemployment rate this time. It's been more driven by an expanding labor supply, although that's typically what happens even in a recession. But if you're going into one, or if we're going into one that's a little bit more traditional in nature, then you're by definition already in it, because that's what the peak is when the sort of the NBER goes back and dates the start of the recession. But again, I don't think it needs to be this sort of bombastic, we're going into an epic recession. You've had some that are a little bit more mild in nature. You've had some that are a little bit more severe. The ultimate trouble with this is that the sample size is just not that large.
I like how you try to talk down the analogy of suddenly heading into a 1970s style recession, because a lot of people will start extrapolating out, okay, stagflation, and it becomes hyperinflation, and all of a sudden, how do we get out of there? At this point, is the bigger risk the deceleration on the labor market, or is it a stickiness in inflation that creates a sort of, I don't know, something that rhymes with 1970s?
Yeah, I think the risk, and rightly so, and the Fed has been pointing to this, and all the Fed speak has been pointing to this, is probably that the labor market's becoming more of the issue that they want to be able to, at least get ahead of, even if it's a couple of rate cuts and hopes to get there. I think that they're trying to signal us in that way. And, this is the part where you try to figure out and suss out what's the actual inflation rate that they become more comfortable with. They're not going to, Powell said it many times, they're not going to wait to get to 2% year over year on PCE or core PCE until, it's mission accomplished. But, the labor market becomes more of I think, a dominant piece of the puzzle at this point. And it's a very different scenario, even just 6 months ago when you had all of these inflation metrics, whether you annualize them on a 3 or a 6 month basis, that were showing we were at 2%, but the labor market was still relatively tight. Now you're in a position or at a point where the labor market's just not as tight. So I think they have a little bit more room to work with there.
The destination we're going towards, I'm just thinking of lower interest rates potentially, lower growth maybe, and higher unemployment rate. It doesn't scream cyclical, small caps and banks. It kind of says, shouldn't we be buying tech?
Yeah, I think that's one of the reasons where we think that this rotation, if you want to call it the Great Rotation or the Great Reaction, whatever you want to label it, I think it has room, but probably more for the profitable and high quality parts of the market. Because when you look at that initial thrust, post June CPI report, it was kind of an everything rally for an index like the Russell 2000. Now that it's started to split a lot more, where even if you go over the past year and you use just one criterion of profitability, whether companies have profits or not, the profitable group is up by almost 20%. The non-profitable group is basically flat. So you have seen, on the part of the market and investors, you have seen more selectiveness when it comes to that index, and I think that will probably continue. But again, I think it's more of a normalization because we have to keep in mind the Russell 2000 is still not back at its November 2021 high. So if this was the case where we were just ripping from those highs and you were at a same stage or in a similar state as the S&P 500, then I think it would be a little bit more worrisome. But right now it seems a little bit more reactionary. And again, to your point, staring down the barrel of a labor market that's still softening and GDP growth that's still cooling doesn't make a whole lot of sense to me as to why small caps would automatically just rip the baton from large caps.
Kevin, this was awesome, and I have to say this line in your note was music to Bramo's ears. Life is simpler when you keep politics out of investing. Did you like that too?
I love that line. He wrote that several times, which I really relate to.
Shows you how I feel about that.
Yeah. I think you're basically like, please do not ask me about it because I won't answer.
You're in good company. We'll let it go. Kevin, it's good to see you. Fantastic. Thank you, sir. Kevin Gordon there of Charles Schwab. Let's give an update on stories elsewhere this morning with your Bloomberg brief. Let's get across to Danny Berger. Hey, Danny.
Hey, John. Israel attacked Hezbollah targets on Sunday and threatened further retaliation for a rocket strike that killed 12 children. Israel also signaled openness to a proposed Gaza truce that could calm the second and more combustible front with Lebanon. Prime Minister Benjamin Netanyahu returned early from a U.S. visit where he was seeking to drum up support. Netanyahu's office said the prime minister held back-to-back consultations with military chiefs and the security cabinet. President Biden will call for term limits and ethic rules for Supreme Court justices later today. It's part of a sweeping new proposal, which also calls for constitutional amendments to ensure that former presidents can be tried for crimes committed while in office. Democrats have increasingly called for reforms to the court amid recent controversies.
Reason. Equity futures right now on the S&P look like this. We'll get back to the markets. We're positive by 0.4% on the S&P 500. Let's get you some morning calls. First up, Morgan Stanley naming Tesla as its new top pick within the US auto sector. The analyst maintaining an overweight rating and street high 310 price target, citing cost cuts and restructuring that have helped to restrict the downside to Tesla's EV business. That stock is up by 1.7%. Your next call coming from Citi, raising its price target on 3M to 133 and keeping a neutral rating. The analyst saying upside to second quarter earnings and a modestly raised 24 outlook are encouraging signs of relative stability. Stock is still lower by 0.7% in the third and final call from CFRA, upgrading Dollar Tree to hold with a price target of 109. Analyst Arun Sundaram seeing softness in its Family Dollar brand and risk tied to Dollar Tree's multi-price point strategy. Aaron joins us now for more. Arun, let's get straight into this, sir, and thank you very much for being with us at a time when the consumer is very much front and center in our minds. And we're trying to work out how different companies are gauging where this consumer is at the moment. Earlier on, we heard from McDonald's and they say maybe this consumer is slowing down. We heard a similar story from the likes of Nestle, from Pepsi too. In the companies that fall under your coverage, what do you see?
Hey, yeah, thanks for having me. Yeah, we're also seeing a slowdown in spending. I think what's a little funny, in my coverage, I cover a lot of big box retailers and packaged food companies. A lot of these retailers have been seeing a slowdown in spending for the past 2 years. But I think we're talking about it more now because you're also seeing, weaker spending in the services side of the economy over the last, say, few quarters or so. But really spending on goods has been, soft for probably the last 2 years, especially spending on discretionary goods, especially, the bigger ticket discretionary items. And now that we're seeing a softness in the services side of the economy, we are talking about, the softening of the consumer a little bit more. But we're seeing the same things. Consumers are trading down. They're opting for cheaper private label brands. They're even opting out of certain categories. In some cases, they're just being very choiceful, discerning in their spending. But like I said, that's been, kind of the trend for the last year to 2 years now for at least the big box retailers.
Well, it certainly reminds me of the difficulties the likes of Target had over the last couple of years. If I go through some of the other companies in your coverage, Amazon, Walmart, Costco, when I hear trade down, a more choiceful consumer, I think Walmart. Is that the winner in all of this?
Yeah, certainly. Walmart has been our top pick in the retail space for the last year and a half now. Walmart is gaining a significant amount of market share. Not just in grocery, which is what they're predominantly known for, but also in their general merchandise categories. You don't really think about Walmart as being like an apparel retailer, a general merchandise retailer, but they're really growing out that general merchandise business, and predominantly because of their e-commerce platform is growing pretty significantly. They introduced a Walmart Plus subscription program. These are all high margin businesses for Walmart, and on top of that, Walmart's also growing out their advertising business, something that we don't really talk about a lot with retailers, but the advertising arm for many of these big box retailers are growing attractively, and that's a much higher margin business than selling core goods, and that's why I think that the stocks for a lot of these big box retailers are up, and I think a lot of it has to do with the fact that sales mix is changing, and they're not just being known for a goods retailer anymore. They're selling advertising, it's healthcare, it's financial services, and like I said, these are much higher margin businesses than goods.
And Arun, this is the reason why. It's sort of a question of how do you get a view on the true consumer. Maybe Walmart isn't the cleanest read because of all these other types of businesses. Certainly Amazon isn't because of AWS, et cetera. With Dollar Tree, is what's good for Dollar Tree bad for the rest of the economy? Is it typically that when those types of companies do well, it signals real weakness for the rest of the consumer spending space?
Well, I mean, in fact, both these dollar stores, Dollar General, Dollar Tree, they've actually been struggling more than other retailers over the last year. And why? It's because they're more exposed to that lower income household, which, as you know, is a little more exposed to the effects of higher inflation, higher interest rates. It's really the retailers that are more exposed to that middle income or higher income consumers is doing much better. So yeah, I wouldn't say that dollar stores are doing well in this environment. They've actually been I would say struggling in this environment. It's Walmart that's really gaining market share at the expense of these dollar stores. But our expectation is these dollar stores will start to recover. I think in the second half of this year, with Dollar Tree specifically, they're like I was saying before, they're introducing this multi-price point strategy in their stores and introducing new price points. And I want to make it clear, it's not because they want to raise prices. They just want to introduce new assortment in their stores. So for Dollar Tree, 80% of their goods are still going to be at that entry level $1.25 price point. Just 20% of their goods are going to be at these higher price points, $3, $5, $7. That's a way to attract more consumers into their doors. And early signs are showing that it's a success right now. These stores where they have these multi-price point products, the consumer basket size is actually 2 times larger. So people are putting more items into their basket when these stores have these multi-price point products, which is great because we're right now in an environment where basket size is actually been shrinking because people have been putting fewer items in their basket. But for Dollar Tree, it seems like at least with the stores that they have this multi-price point strategy, people are putting more items into their basket.
I've been waiting for them to rebrand as $5 Tree, but evidently that's not happening. I am wondering, when you talk about Walmart and the likes of actually really gaining on advertising and on some of the online spending, how much they're actually winning market share, not just from other retailers, but from Amazon, the one that kind of coined the whole kind of online marketplace.
Yeah, I mean, Amazon's the big gorilla in the room, especially in the e-commerce space, and now other retailers are really trying to catch up. Walmart a few years ago introduced Walmart Plus. That was their subscription program intended to compete against Amazon Prime. We think Walmart Plus is so far been successful. Walmart doesn't necessarily release membership statistics on Walmart Plus, but we do see that Walmart Plus subscription base growing. Even Target, they're a little late to the race here, but just a few months ago, Target introduced their own membership program called Target Circle 360. Memberships are really a way to drive consumer loyalty and drive traffic into their stores. And it's also a way to grow margins and reinvest in your business. So I think you're going to see more retailers try to offer these membership programs. The problem is that how many memberships can a consumer subscribe for? So there's clearly going to be some winners and some losers. I think the retailers that are going to be winners are the ones that have a very wide assortment of products. So the Amazons of the world, the Walmarts, Costco is they're also a subscription program given their warehouse model. But I also believe Target is also going to be a winner of the subscription program. And like I said before, these subscription programs is also a way to grow your e-commerce business, which also help you grow your advertising business. And right now, advertising is where the margins really lie. And these retailers are really leaning into their advertising business to try to help grow profits. off. It's
just amazing. Just an amazing turnaround. I appreciate the update, sir. Arinson down there of CFRA. Just kind of frame it at the end there. How much of a challenge these companies have become to the likes of Amazon to hear the advertising business. And I know we've heard this before, but the ad business is becoming a bigger part of some of these companies.
Yeah, and Walmart's really been ramping up its online presence in a much more significant way. I love how some of these consumer-facing companies are increasingly anything but consumer-facing companies. Airlines are actually credit card companies. You have Walmart's, but the retailers are actually advertisers. You know, it's sort of like, you know, it's not really good to just be consumer-facing. We also have 15 other businesses. Check them out.
Things have changed. Things have changed a lot. Equity futures right now positive by 0.5%. 1 hour away from the opening bell. The lift continues. We'll catch up with James Camp of Eagle Asset Management and Zach Griffiths of Credit Sites. We'll catch up with them just after the commercial break.
Will AI provide that you're not getting currently in search and other ways that we don't even realize we're having certain AI-infused programming? I don't know exactly how well it can be. It's sort of personalized Bitmojis. And
is that what they're touting?
I don't know.
Okay, Apple's down by about 1/10%. That's not getting me to upgrade. Let's put it that way. Big week of central bank decisions coming right up with the Fed very much in focus. The FOMC widely expected to keep rates on hold this Wednesday, but set the stage for a September rate cut. Joining us now to discuss is James Camp of Eagle Asset Management alongside Zach Griffiths of Credit Sites. Gents, great to catch up with you both. Zach, I want to come to you first, sir. Give us a read on what you're expecting this Wednesday and how it might set us up for what could happen in September.
Yeah, John, we are looking for the Fed to make adjustments to its policy statement to indicate more of a concern in terms of the labor market, or at least dial back their assessment of strength in the labor market and continue to emphasize progress. On the inflation front, we expect Chairman Powell to indicate a willingness to cut in September. We don't think he'll be very explicit in saying that they will cut, but keep options open, keep that data-dependent mantra. We think the data supports a cut in September.
James, of course, we're all much more interested in the 100 basis points after that, if there is a 100 basis points after that. What is the destination you think this Fed is heading towards, and what kind of economic regime do you think we're in that guides that?
Well, good morning. Good to be with you. We're in a reflation regime, right? The anchoring that we had in the post-financial crisis period up to COVID is gone, and we have a new economy. And that new economy has more stubborn inflation. You know, we've written about onshore, we've written about pricing power, we've written about a tighter labor market. I think the Fed does cut in September. This is the clearest data that they're going to have to give them that opportunity. But the base effects and some of the inflation inertia is going to come back in the fourth quarter. So I don't consider this a Fed pivot. I consider this a Fed sort of getting back to sort of more normal on the funds rate. But I wouldn't extrapolate this September meeting, which is likely to be a cut, maybe even 50 basis points, into a protracted policy adjustment over the next couple of quarters. This is a late 2025 kind of phenomena where we'll see what the terminal rate will actually be. But it's that number's not imminent.
Hold on a second, James. Did you just say that there's a real possibility that the Fed will cut by 50 basis points in September?
Yeah, I do think that's the case, Lisa, because I think that this is going to be the clearest data that they'll have to give them the inflation cover. And I think they wanted to move the last couple of hikes off the table. So I think this is the window. This is a kind of a little bit of spitballing with the inflation data. But we know if we look at the data series, it's not going to get easier to make the inflation case in the back half of 2024.
Okay, so this is basically they have an opening. So let's go full. I mean, Zach, what do you make of that? Do you think that that's a feasible possibility that the Fed's going to cut by 0.5 percentage point?
That's not our base case, Lisa, and I think that would perhaps spook the market a little bit in terms of that big of an adjustment when just a couple of weeks ago, policymakers were saying they need to see a lot more data in terms of being confident we're sustainably moving back to 2%. So I'd almost think of that as having the same impact as cutting this week, showing the market perhaps there's more to be concerned about. So that's not our base case. We do think the Fed is going to be easing at a steady clip once they go in September, really trying to bring that policy rate back towards something that looks at least a little bit more like neutral. We think we're coming from a pretty restrictive rate now, which is not what the economy needs. We're seeing signs of slowing, especially in the consumer. We expect that to be a bigger market driver in the second half of this year and into 2025.
Zach, just to be super clear, are you making a growth call here, not an inflation call?
Well, that was a call on growth coming down. We think moving back toward below potential is what you're going to see over the next 12 months. We've had extremely strong growth and still had inflation come down quite a bit. So we think with inflation where it is, the Fed's starting to ease. We're already seeing signs that the economy is cooling. We think that continues and starts to have a bigger impact from a fundamental perspective on where credit spreads go from here, which is why we're in a bit more of a defensive camp than we have been for much of the past 2 years.
You've set us up with the market conversation. Let's go there. Let's stay on it. Zach, if you're looking for wider spreads potentially, where's the 10-year? What kind of level of credit spreads are you looking for into the growth slowdown that you're expecting is going to trigger quite an easing from this Federal Reserve?
So we're looking for the 10-year to go back to 3.25 at the end of the first half of 2025, John. So that's a pretty big move lower from where we are today. And we have investment grade credit spreads going to 120 basis points, high yield to 400 basis points. So not a terribly huge move in terms of spread widening, as we think the technicals, the cash on the sideline, and plenty of cash that we think wants to be put to work in other asset classes provides an offset to more of this fundamental concern we're expecting to be driven by a more notable economic slowdown than what's currently priced into consensus expectations at this point.
This is great because both of you kind of highlight the two sides of the debate right now. And then I think it's a wonderful thing to have. James, it seems like you're more constructive. You think that the Fed is going to cut for the right reasons. They have an opening to do so to prolong the economic cycle. Zach, you seem a little bit less constructive. James, what makes you think that this is going to be a good kind of rate cut in the sense that it's just simply to adjust policy mid-cycle to allow growth to continue?
I think there's two financial conditions we have to look at. For large cap, big companies, financial conditions are extremely loose. For down market consumer, this is the bottom 80% of our income strata. Credit card debt is high. Credit card payments are high. And the Federal Reserve policy has directly impacted, those down market consumers. The credit conditions in the capital markets are still loose. Equities at all-time highs. The VIX low. Credit spreads, as your other guest just mentioned, very, very tight. We have a very bifurcated economy, and I think the Federal Reserve has to be mindful of the fact that housing affordability is at 40-year lows, that the down market consumer is under significant strain. We saw that with some consumer discretionary earnings this morning. So I think this is more an opportunity and a window to kind of get right or closer to where the policy should be. But I will tell you that the inflation data is not going to be constructive in the back half, and they're not going to have this sort of wide open field to begin a real significant easing cycle for the next couple of quarters.
Well, James, though, do you agree with Zach that means probably wider credit spreads than you could end up seeing, maybe a little bit, I'm just extrapolating here, putting words in Zach's mouth, he can correct me, but basically potentially a reversal of the small caps and sort of reversal of just sort of this belief in a cyclical trend. Do you think that we're going to see that kind of response, or do you think that people are going to welcome some sort of adjustment by the Fed as allowing that to sort of right-size itself, to allowing the cycle to continue?
I think it's the latter. I don't think corporate spreads are bound much wider from here. There's a lot of demand. We know that at peak Fed, which we certainly can both agree, I think we're at peak Fed, that corporate credit, that municipal credit, that bonds outperform every time. Go back to 1989, you have 5 Fed tightening cycles. And at peak Fed, you have great returns to fixed income, and you have great returns to dividend growers. And as you mentioned, that rotation that began July 11th with the more benign inflation data into small cap out of mega tech, that has also buoyed the dividend trade. So what we have now is a very generous income market for investors, and we also have a market that will be underproductive for cash. Cash yields today will not be cash returns over the next 12 months. So clients and investors that have money to invest, the income space looks extremely generous, both on the dividend and on the debt side.
Zach, I want to give you the final word. You can use your own words. What's your response?
Well, I think the huge differentiator here is, are you a total return or excess return focused investor? We think the next 12 months look very solid from a total return perspective. If you're focused on that excess return and that credit spread component, it's a little more difficult. And so overall, we do think it is a positive environment for fixed income, but starting to see that spread widening. If you're a credit and excess return focused investor, you need to keep an eye out for that.
Gents, this was great. Zach Griffiths of Credit Size, James Camp of Eagle Asset Management. Thank you very much. Looking ahead to a massive week with the Federal Reserve and all that data coming right up.
You know what we didn't even get to? The quarterly refunding announcement. And you know who's going to talk about that? Zach Griffiths. So we'll have to have him back sometime, because he was saying it's actually really significant. He said that actually could be, market moving.
Okay, is Zach still there? Can we find out? Is he still there? Or have we let him go? They're going to find out for you. All right, we can do this in real time. You change the whole show.
All right, we can let it go.
He's good. He's here right now.
He is?
Yeah, I've got him back in. Go for it. You want to bring him in?
Yeah, Zach, just quickly before we let you go, and we brought you back on just for this, how important is the quarterly refunding announcement?
We think it's important, but we're not expecting any major changes this week. I'd be focused on what happens this afternoon with the quarterly borrowing estimates. I think that's more likely to surprise the market than what we hear on Wednesday morning, but that's going to be huge. There's a lot of focus on it now. It's something I've focused on for many years. I'm surprised to see how much it's in the market. Overall, no change. We're not expecting that to outweigh the shift in monetary policy and the economic landscape, which pulls yields lower.
Well, that was anticlimactic. Thanks for jumping back, Zach. Appreciate it. Thank you. Zach Griffiths there at Credit Size. I'm going to go now, okay? Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. A check on McDonald's shares in the pre-market up more than 1%. Sales declined for the first time since 2020 from international to U.S. locations. Each of McDonald's geographic footprints saw sales declines for an overall drop of 1%. The estimate was for a 0.8% growth. The company's CEO said consumers were being more discriminating with their spend. McDonald's and its competitors are now offering discounts to lure back customers. McDonald's latest is a
Also coming up on Wednesday, Mike McKee drops by to give us his thoughts on the data for the week ahead. Mike McKee, good morning, sir.
Good morning.
All that data, just where is this economy right now going into this Fed decision on Wednesday?
Well, I'll talk to you on Friday when I see all this data.
Come on, work with
The economy is in pretty good shape. It's slowed down. It hasn't crashed. Inflation is coming down according to all of the latest data. And Fed officials who've been talking to CEOs say that people are still relatively optimistic. So we're probably set up for the Fed to hint at a rate decrease ahead. I was kind of thinking last night, it's a bit like one of those gender reveal parties where maybe we give Jay Powell a pinata and he hits it, and instead of boy or girl comes out as September or November, and we see which one they're actually going to do.
Is that an actual recommendation for the Federal Reserve? You're going to give that to Chairman Powell?
The ratings would go up. A lot more people would watch you.
I imagine they would. Thanks for that, Mike. We've got to do gender reveals. Every payroll's Friday, every Federal Reserve.
I mean, between the Bachelorette that's going on with the Vice President's Day, and you've got, gender reveal for the Federal Reserve, what kind of country are we coming to?
If you were going to schedule this for ratings, though, I'd have payrolls on a Wednesday and the Fed decision on Friday.
Exactly. But that's a problem for the Fed because they don't know what's going to happen. And if we do get a 0.1% rise in unemployment to 4.2%, that should trigger the SOM rule. And while the Fed isn't particularly worried about it, it'll obviously worry the markets. And it'll be, are they now going to be able to, we'll have the Fed say whatever they say, the markets will adjust on Wednesday. And then Friday, it may be a whole new story.
Okay, just going with the gender reveal party, that's not going to happen anyway until Jackson Hole, right? I mean, we're not going to actually get anything from them. I mean, we've been basically setting up that Wednesday is going to basically be them saying we're data dependent. Any data point could be live and could really tip us over the edge. Is that not what we're going to hear from them?
I think they pretty much have to give some sentiment about September because the market's all focused on it. If you're waiting till, why do you wait till Jackson Hole? You don't really need to. If they think that rates should go down now, you can say you're going to cut rates in September or hint strongly at it, and then rates are going to go down because people are going to start pricing it in. So you get the effects of a rate cut. And you've got a lot of people like Mohammed El-Arian and Alan Blinder today saying the Fed needs a cut right now.
They should ask Christine Lagarde what it is to pre-commit to a cut and see whether or not they actually want
to. Well, that's why they'll dance around it. They won't say September.
Correct. Maybe we could ask Christine Lagarde. There is this issue, though, of some of the sleeper data points that we get. JOLTS data, we also get ISM manufacturing. What are you watching in terms of some of those sort of tertiary indicators that could be as telling or market moving as some of these other bigger data points?
Well, we're watching ECI, which is on Wednesday as well, because the Fed follows that in terms of pay and compensation and whether that's putting upward pressure on inflation. And it's been coming down, so we'll see if that continues to happen. Obviously, ISM manufacturing, we'll look at the sub-indexes there about new orders, see what it looks like going forward, and prices paid. And jobless claims. Everybody wants to know what's happening with the labor market, so that'll be interesting to see. But obviously, jobs Friday, the big day. the big data of the week.
Just short of 180 is the estimate, the median estimate in our survey. I think it's 178, Mike?
175 or 178, yeah, it's been bouncing
The
around.
170s, as that changes as we get more estimates and they come through into our survey. Mike, great start to the week. Appreciate it, sir. Mike McKee there on the latest massive week ahead.
Yeah, that might end up with a gender reveal that says December or September, and it will be September. Honestly, it is a massive week, and I think we've really broken it down to the idea of economy. We've got decisions from central banks, and we have earnings. Everyone's been saying earnings so front and center, given how much of the index is going to be reporting this week.
Light on politics. How relieved are you? Very.
Anne-Marie's not even here. She's like, peace
You're going
out.
to get a
I'm
vice
gone.
presidential nomination.
Yeah, exactly.
Anne-Marie's taken a week off.
Yeah, exactly.
That tells you everything you need to know about politics.
It'll insert itself somehow.
I have no doubt it will. Coming up tomorrow, here's the lineup. Bob Dole of Crossmark, Mona Mahajan of Edward Jones, Matt Hornbeck of Morgan Stanley, Tiffany Wilding of PIMCO. Have a wonderful week, a busy week ahead of us all. Thank you very much for choosing